Let's start. Last part, I think we were off track questions. Let me move to evaluations now. Come to slide number 21. Look at slide number 21. We have valuation methods. Give me a minute's time. These are the methods we'll cover. These are the methods we'll cover in the M&A. Valuation methods have. Free cash flow is the most important method which will be used. Net asset method is accounting, which we'll see along with the questions. Dividend growth method we have been doing. Earnings growth method, again what we have been doing over a period of time. So will be chop shop method is a breakup value method. Value added methods I have taken a separate chapter, EVA, and capitalization of earnings accounting method will be there. Relative valuation we have seen. I'll cover one by one. First we'll go to the net asset method. Come back to number, I think important from the exam perspective. Forty-seventh. Read question number 47. Basically we'll have a capitalization method, and with that, after that we'll add up the assets valuation method also. Let me quickly read out. This Eagle Limited reported profit of 77 lakhs after 30% tax for the financial year 11-12. An analysis of the accounts revealed that income included extraordinary item of rupees 8 lakhs and extraordinary loss of 10 lakh. We'll adjust the extraordinary expenses and income. The existing operations except for the extraordinary items, are expected to continue in future. In addition, we have the results of the launch of the new product are expected to be as follows. They have given sales, material cost, labor cost, fixed cost. You're required to calculate the value of the business. That's nothing but enterprise value. Capitalization rate 14% we have. He has given a profit after tax. Since we need to adjust the extraordinary expenses and extraordinary loss, the expenses would be added back and income would be subtracted. So using a profit after tax, I can reverse calculate my PBT. PBT would be 77 lakh divided by 0.7, 110. In that you will adjust extraordinary income of 8 lakh. That means you will subtract minus 8 and add back 10. This is with the earlier operations. Now from the new operations we can find out the new income. 70, 20, 12 and 10. We get something 28. So from here now 110 minus 8 plus 10 plus 28, 140. We call it as a future maintainable profit before tax. Future maintainable profit before tax, that comes 140. So 140 minus tax. Tax is what rate? 30%. How much is tax? Tax is 42. 30%. Okay. I get FMP at 90. The way of reading is, if 98% is my profit, which is equal to 14% return, then what is my capitalized value? 98 divided by 14% will give me the capitalized value 700. There could be some alternative also. I am not discussing that alternative. In exam, if it comes, do the same way. Although there could be some other alternative by which answer can be calculated in this question. 700 lakh comes the capitalized value. Now he is not mentioned clearly. Since we are looking at a PAT level, that means it's coming as the value of the firm. If he would have asked value of equity, then I could have done something else, and then there could be some assumptions regarding the rates also. So that kind of a complexity I have not created, because he has not touched that kind of a complexity till now. Otherwise this can be modified in some other ways. 3-4 ways we can modify it. The second part we have, determine the market price per equity share with Eagle Limited. Only thing actually keep in mind is, you have to compare apple to apple comparison. If you are looking at the profit at firm level, it has to be the KO. If you are looking at the cash flows or the profit at equity level, it has to be KE. Although generally the bifurcation we have not seen in the financial management papers, but technically it has to be equity versus equity and the firm versus firm, which I'll be touching in the cash flow statement. So accordingly, same concept can be applied in the capitalization value. So since I am assuming this is a KO level, because we are looking at the PAT level, if he would have given slightly if and but, or if some assumptions were made, then automatically answers would change. Determine the market price per equity share with Eagle Limited share capital being comprised of 1 lakh 13% preference shares, 100 each, 5 lakh equity shares of 10 each, P ratio being how much time? 10 times. Now what we will do is, you got future, we use the word future maintainable because we are forecasting. Anything which you do the valuation, anything which comes forward looking statements would be added up. So in this case what will happen is, you have to subtract from the PAT level. PAT came 98. Sir, what method will apply? How do we come to know? Since P ratio is given, so prima facie it should give you a hint. It has to be P multiple approach, relative valuation. That means P ratio into the EPS, that will give you the share price. And he is asking, I think, share price only. Yes, he is asking market price of 1 lakh 13%, 1 crore into 13 lakh would be preference dividend. How much do we get here? 85 lakh. That's profit for equity shareholders. Since we need to calculate the number of the EPS, divide by number of equity shares, he has given how much? 50 lakh. My EPS is equal to 1.7. 1.7. That's fine. So if it comes 1.7 into P ratio, how much? And how much do we get? That's fine. Let me cross check answer. Valuation method. We will be seeing all of them, don't worry. 47th. I have calculation of FMP, PAT level, PBT, extraordinary, future maintainable before tax, then it gives me FMPAT PAT, that comes 98. Value of the business is future maintenance profit divided by capitalization rate. It becomes what? 700 lakh. Market price of the share is equal to EPS into P ratio. The EPS we calculate is 1.7 multiply by P ratio, you get 70. Similar question which came is 46th, that's on net asset method. Basically 46th question and 47th were more or less same. 46th is also from the accounting background. 46th is purely accounting background. Right. Go back to 46th and read once. 46th question, read back. Forty-sixth question. H Limited agrees to buy over the business of B Limited. Effective 1st April, summarized balance sheet of H and B are available on 31st March 12. Then you have a balance sheet available. H is a acquirer, B is a target company. Paid up share capital, there is no debt, so doubt will not have whether it's a KO, KE, capitalized value is value of the firm or value of equity. Anything which will come is value of equity only. Total assets we have a 1300 lakh, 31.5. Assets we have net fixed asset 220, etc. Deferred taxes given. And then he says H Limited proposes to buy out B. And the following information is provided to you as part of scheme of buying. The weighted average post-tax maintainable profit he has calculated for you, unlike the previous question. The weighted average post-tax maintainable profit of H and B for the last 4 years are 300 crores and 10 crores respectively. So they have given weighted average post-tax maintainable profit of H and B Limited. Both companies envisage capitalization rate of 8. So they think that the rate would be 8% capitalized value. H Limited has contingent liability of 300 crores. While doing valuation, contingent liability would be adjusted for the valuation purpose. H Limited to issue rupees 100 each to the shareholders of B in terms of exchange ratio as arrived on fair value basis. I don't know whether in accountants you do it or not. Fair value basis is combination of two methods which he will mention in our case. That's net asset basis and capitalization method. So he will mention it out. Even if he does not mention, fair value basis is, this is a conventional method of accountancy. Fair value basis, please consider weight of 1 and 3 for the value of shares arrived on net asset basis, capitalization method respectively for both H and B. You are required to arrive at the value of the share of both H and B under net asset method, earning capitalization and exchange ratio of the shares of H to be issued to the shareholders of B on a fair value basis, taking into consideration the assumptions mentioned in point 4 above. Now, language is not straightforward. If I put very straightforward, we need exchange ratio. Exchange ratio has to be based on the price. Price has to be calculated based on the net asset method and capitalization. So first I'll do is I'll bifurcate and then I'll reread the question so that the confusion does not arise. So what we do is we'll bifurcate the question. On net asset method, I'll calculate the share price. On capitalization, since capitalization is simpler, I'll calculate the share prices of both. First, the swap ratio is target company divided by acquirer. Till now, this only we have learned. We have not learned the reverse way out as of now, that under what circumstances reverse can be done. In this case, 350 divided by 100, how many shares we have? 3.5 crores. I think shares will come. So 650 divided by 10, 0.65. Now, what I have here is, if the post-tax maintainable profit of H is 300 lakh, if 300 lakh is equal to 8%, then value would be equal to, the value would be equal to 3750. Similarly, B has maintainable profit of 10 divided by 8%, the value would be 125. This is the value, entire value. When you divide this entire value, when you divide this by number of shares, that is 3.5 crores, divide this by 0.65 crores, we get some number. First one is 10.4, second one 192.31. Although if nothing was said, I could have taken the ratio and calculated the exchange ratio. This is one. Second part, he says we have to calculate share price based on what? We have to calculate share price based on net asset method. Net asset would be basically, in B case you have 31.5. 31.5 divided by the number of shares 0.65. You will get the price for how much? 48.46. 1300 minus, there was a contingent liability 300. So value would be of H limited on net asset would be 1000 crores divided by 3.5 crore shares. You get the price 280.71. Now what you can do is you can find average, weighted average of H limited price, weighted average of the B limited price, weighted average, and he has said the weight should be applied for the purpose of net assets is 1/4. 1:3 means 1/4 to the net assets, earnings capitalization 3/4. So what I can calculate is weighted average price. So weighted average price of H limited would be, net asset is 285.71. 1:3 means I'll apply 1/4 plus 1071.43 into by 4. This will be the price of H, and B limited I'll calculate same way, 48.46, 1/4 weightage 192.34, 875 and 1. Now swap ratio you can base out accordingly. 156.35 divided by what? Point something comes now. There could be other way also, mathematics you can do. I have taken weighted average prices and accordingly done. This was number 46. On slide number 26. Calculation of share price based on net assets method. H limited, B limited I have. So we calculate the net assets value, divide by the shares, number of equity shares I have taken separately. When you divide by it, you get share price 285.71, 48.46. Similarly, based on capitalization method, the capitalized value we got post-tax maintaining profit. Question gave us capitalization rate 8%, value of equity. Since there was no debt, directly comes the value of equity only. And we have share price, also share price. Exchange ratio is weighted average price of H, weighted average price of B limited, and then target by the acquirer. You get the swap. Get the swap ratio. That's net asset method. Since you have accounts background, they would be very high chance they'll be asking you net asset method in the exam. Very commonly repeated method. Next method is again a simpler one. You want to check the calculation, you can check. Weights I have applied because he only mentioned. Fair value basis is basically combination of the net asset method and capitalization method. This used to be FR paper, in fact previous accounts paper, valuation question, which came in our exam also, I think 12 somewhere. Next method we have the top shop method, which is the simplest of all of them. It's a breakup value approach. Breakup value is when you divide the company's value into separate pieces, and most commonly used. Actually that method is not, I should not say method, that's a way of valuing the each division. For example, if any company is selling off any particular division, then they should not value the business as a whole. They can do the valuation of every department, every division, or they can do valuation of the business based on different parameters for the company. For example, chop shop is basically, the word comes from chop shop only, breakup. Wipro, let's suppose I take up, Wipro has n number of divisions. If you go back and check, they are not into only the IT, they have some different divisions also. There will be division, let's suppose A, B, C and D. I can do the valuation of A division based on sales basis, B based on sales basis. For example, one division could be IT, one division could be belonging to FMCG, one could be from the telecom side, or other any divisions can have. So I can divide this and value each division based on their sales multiple. Each division can be based on their EBITDA multiple. Each division can be based on their operating multiple. Every division will have separate valuation. For example, a telecom sector might command different sales multiple. The IT sector might have a different sales multiple. IT sector will be more towards the income EBIT based, because in IT sector, for example, the depreciation is very less. So it could be, the weightage could be given more towards the operating income level. So they can have valuation of every division based on different parameters, and then accordingly they can combine the value as a whole. So we call it as a breakup value or subdivide the company's valuation. Entire company, instead of valuing on a single parameter, we are doing a different parameters of it. Similarly, you can have the companies like someone who is in the airport, someone in the roads, someone in the ports. So there could be different parameters of doing the valuation of each. Reliance, any company which is conglomerate or which has n number of division faces this challenge. Any company which is segregated, they will not have the problem which exists here. Based on that, chop shop method is a breakup value. The question would be very straightforward in the exam. Twice it has come, I think. That's not, question is not challenging at all. 37. Using a chop shop approach or breakup value approach, assign a value for Cranberry Limited, whose stock is currently trading at a total market price of euro 4 million. For Cranberry Limited, the accounting data set forth three business segments: consumer, wholesale, retail and general. The three segments of a company. The business segments are wholesale, retail and general. They have given the sales of all three divisions separately, assets of all three divisions separately, operating income of all three divisions separately. Industry for pure play are similar firms. Similar firms have been compiled and summarized as follows: wholesale, retail, general. The capitalization by sales, capitalized by asset. Let me put up the focus on capitalized by sales. The 0.85 means if wholesale business has 1 rupee of a sale, valuation would be given as 85 paisa. That means if they have a sale of 225, their value would be 2,25,000 to 0.85. Retail segment, sales valuation is 1.2, means if they generate 1 rupee of a sale, the value of the business as per the retail is on the sales is 1.2 times. That means in this case it will be 7,20,000 into 1.2 times. 0.8 meaning is 1 rupee of a sale will give the value of a 80 paisa. Similarly, if you look at the operating income level, it says if you generate an income of 1 rupee at operating level, wholesale will command a valuation of 9 times. If you generate an income of 1 rupee in the retail segment, valuation is 8 times. And if you generate an income of 1 rupee, valuation is 4. You simply have to do, let's suppose I have to value the wholesale business, retail and general based on sales basis. Will multiply respective sales where their capitalized multiples. So these multiple will multiply, will get the valuation based on the sales multiple. Segment assets, 70 paisa means the entire segment, if assets have to be sold, so valuation is 70 paisa of them. We can multiply 6 lakh, 5 lakh, 4 lakh into 0.7 and then we can get the value. Same with the operating level. So three bases we can calculate, each division based on sales basis, each division based on the asset, each division based on operating, and then entire based on sales, entire valuation based on the operating income, entire valuation based on the assets, and average of them could be considered as a value of the business. You have to put and multiply numbers. Only thing he can change going forward is depending on the circumstances. He might say if that's a enterprise value, then debt he gives you and just for the debt, and you calculate the market cap and then you calculate the share price. That's only the change he can bring out. Shop by given 23rd slide I have. Value of the business is equal to, based on sales basis, wholesale, retail and general. Sales basis, capitalization by sales, so you multiply, you get a capitalized value. Similarly, based on asset, multiply, you get the again a capitalized value. Based on operating income, you multiply and get the value. Then theoretical value of the business would be average of the theoretical value would be average of these. This chop shop method. We cross check the numbers if you want. Then we move to one of the most important methods of this chapter, cash flows. Want to cross check the numbers? Quickly cross check please. Now I'm moving to one of the most important methods of this chapter, in fact of the practical scenario, practical world also. Free cash flow approach. We call it as a discounted cash flow also. Most sought after method by the people who want to enter into the valuation stream. And for you it would become slightly easier since you from the accounts background, so learning would be easier. Free cash flow approach, FCF. We can have two type of cash flows. One is called FCFF, free cash flow to firm. Second is called free cash flow to equity. Now before I read this numbers, or how do I read that valuation on the free cash flow, your cash flow statements have three activities: operating activity, investing activity, financing activity. Any cash which is left after taking care of operating and investing activity is called cash flow for firm, because that cash would be divided between debt and equity holders. Investing, financing is nothing but debt equity. Any cash which is left after taking care of operating activity is, because by using the same language I'll be creating a formula. Formula should be very comfortable. So any cash which is left after meeting operating investing activity is called free cash flow to firm. And if I take care of the debt portion also, if the debt portion is also taken care of, we call it as cash which is left only for the equity holder. First of all, firm cash flow is any cash which is left after meeting operating needs, and the capex needs we call it as, capex is basically investing activity. Any cash which is left after taking care of operating needs, capital expenditure needs and debt holders needs is called cash flow for equity. That's there. Now definition wise if I read, it's cash left after meeting operating and capex needs. Capex is the word used for capital expenditure. Since we are doing a forecasting, so we'll have only a positive capital expenditure. FCF is cash left after meeting operating, capex and debt obligation. If you try to look at the diagrammatical presentation, you will find this same as the dividend discount method. Look at the diagrammatical presentation please. If you look at the diagrammatical structure, you'll come to know that the this tells me how do I do the valuation. Cash left after meeting operating capex. I'm not learning a formula. I'll do in 2 or 3 parts this topic. One is what type of questions you get. One question, data would be everything available. You just have to discount back. Second is you have to calculate terminal value. Cash flows will be given, discount back. Third and the last part, which has started coming in the recent exam, is entire data we create. So formula I'll come at a slightly later stage. The objective of the exercise would be calculate free cash flows of the firm, then calculate terminal value and bring it back to 0 period. It's as good as forecasting of dividends D1, D2, D3 and P3 and then come back. Similarly, if you have equity cash flows, you forecast the equity cash flows, terminal value, bring it back to 0 period. The objective would be value of firm is equal to summation of present value of FCFF plus present value of terminal value. Present value equity would be FCFE, present value of terminal value. Fourth point we can add from our side, discount rate to be used. Discount rate to be used. So discount rate in this case, since we are doing a valuation of firm, firm cash flow would be discounted using what rate? KO. Discount rate in this case would be KE. Discount rate in this case would be KE. The firm means for the firm it's equity, and formula will create. When we create a formula, I'll again come back to this cash flow, and because my formula is based on exactly cash flow statement, it's easier for a CA chartered accountant to understand the free cash flow. Only thing is forecasting has to be done. So free cash flow is the cash left after meeting operating, that's operating activity, and a capital expenditure needs. It's operating, capital expenditure and debt obligation. Any cash which is left is for the equity. First type of question, look at question number 7 please. First variety of a question. Read question number 7 once. All questions under this topic would be ultra important, whether nicely framed, not nicely framed, etc. There are instances when the questions are not framed properly. Read question number 7 quickly please. Language might not be beautifully framed. AB Limited is planning to acquire and absorb the business of XY. The valuation is to be based on the recommendation of merchant bankers. Consideration is to be discharged in the form of equity shares to be issued by AB. AB is acquirer. Target company is what? XY. As on 31/3/2006, paid up capital of AB consists of 80 lakh shares of 10 each. The highest and the lowest market quotations during the last 6 months were 570 and 430. That's the share price of the AB. For the purpose of the exchange, the price per share is to be reckoned as the average of the highest and lowest market price during the last 6 months ending 31/3/2006. First paragraph only tells me if I have to issue some shares, shares would be issued, purchase consideration divided by the issue price. Issue price would be nothing but average of these two, and this is not something they want to assume from their side. These could be as per the regulatory requirements when you will study SEBI guidelines or valuation principles. Otherwise anyone can issue shares at any price. For example, any discussion done in the class is only for educational purpose. Idea, for example, has a board meeting. I love idea, you know, because of this number. They have board meeting on 27. Share price is approximately 17.5. It will fluctuate heavily. If anyone has an interest, by chance out of their spare time, watch couple of times during the day: Monday, Tuesday, Wednesday. Monday they'll fluctuate, Tuesday will be again speculation, Wednesday would be speculation. Result will come. Now if let's suppose price is around 18, if they say we'll issue the shares at 25, who will take at 25? If they say we'll give the shares at 12 rupees or 11 rupees to someone, the price will drastically fall. The price will drastically fall. Now you can say, sir, how can they issue the price at such lowest? Because I'm not going into the guidelines. If you go back and check their 6-7 months price, you'll find a very heavy range. The share has moved almost in 1 year from 6 rupees, 5 rupees 80 paisa to 18 rupees. So range they can create. So when you say any price which is appearing, when they say use this kind of a language, although while doing question you do not put focus on, but anyone who is interested in the valuation field, and when you go, you will have to read the regulatory requirements. It's not at random you will do it. For example, a lot of QIPs comes, government is selling off their stake in some of the companies. You'll find they do some valuation, they do some pricing. The pricing is based on certain parameters. So this paragraph is exactly focusing on that. Issue price would be approximately 500 rupees. For us, it's only 500 rupees knowledgeable for the purpose of exam. Then it says, he has given, when I used to do this question 3 years back, I used to say there is no use of paid up. Now paid up, partly paid up has become very relevant in today's world, because we have a lot of companies which have partly paid up shares. So partly paid up shares are there and fully paid up shares are there. And I would not be surprised, partly paid up question has not come for a long time. This question would repeat depending on the current scenario of the market. Not maybe this question, not some other question, I don't know, but they'll repeat it out. Then fixed asset given. Indeed, independent firm of merchant bankers. Merchant bankers and investment bankers. That's a local term for investment bankers. Engaged for negotiation, have produced the following estimates of cash flows. The following are given what? Cash flows. Although they use a word very relaxed or ordinary way, after tax earning for equity. It is not after tax earning for equity, it is a cash flow. It is a cash flow first year forecasted. Sir, how do you know this is first year? Because you were standing where? 31st March 2006. This is first year, then second year, third year, fourth year, fifth year, and they have given the terminal value. Everything they have done, only you have to do is what? Discount back. It is the recommendation of the merchant banker that business of XY may be valued on the basis of the average of aggregate of discounted cash flow and net asset value. Now again I am saying, if you read very thoroughly, you will come to know we are not doing value of business, we will arrive at what? Value of equity, because cash flows is only for equity and net asset is also for equity. So we will arrive at equity. So do not read much into these lines. It's a general tendency of the institute to use this kind of language. Value of business, because value of business, when I say, generally it should be value of business including a debt, enterprise value. So since you are doing a discounted cash flow net asset method, that means you will arrive at what? Value of equity. Now what you can do is, he has said that you calculate the value of equity based on two methods. Whatever valuation comes, take the average of it. Now what we can do is, on your calculators you can do me a simple calculation. Since we have a cash flows available and discount rates available here, you can multiply 0.105 into this, m plus button 120 into this, 125 into 120, 100 into 200 into 0.66. You can tell me the value based on the discounted cash flow. The practical name is discounted cash flow actually. How much do we get? 592.40. And net asset is nothing but equity share capital plus reserves and surplus. Net asset is as per the above, it's basically 250. So you have valuation both the parameters. Question was not tough. He says, merchant banker says value based on average, no weighted average given, so simply take average of it, divide by, that's the consideration or purchase consideration you call it as, for 21.2 lakh. First part, he asked us what? First part, calculate the value of the equity, that's correctly word used, of XY, number of shares to be issued. Now number of shares to be issued, if this is my purchase consideration, what price he said I'll issue? 500. So this is in lakhs. So what we'll put is, sir, 421.20. You can put down lakhs of 50 to the power 5, divide by, or you can multiply 421 comma 20 comma 000 and divide by average price is 500. How many shares? 84,040. These share would be issued to fully paid and partly paid. So fully paid and partly paid shares both will be issued, and their proportion is 250 in the amount term. So we can have 84,240 into 200 by 250, 84,240 into 50 divided by what? Get some number. 67,000 something. How the answer would evolve around? We have value of equity based on net asset method. Net asset will give me this. Discounted cash flow will give me 592. Value of equity is average of net asset discounted cash flow 421.2. Number of equity shares issue, average price 500, and number would be 84,240. Basis of allocation would be 84,240 fully paid and partly paid. Check the number once. That's first type of question which comes, in which both values would be given to you. Second variety of question will come. He'll give you forecasted cash flows or help you to calculate the forecasted cash flows somehow, and then he'll give you, ask you to calculate terminal value. Second part, terminal value we are looking at. Now terminal value is exactly same way what you do. In this case, if I put terminal value here, for example, is nothing but, this is a general formula. I'll remodify this formula into something called normalized year going forward. First type of a question which comes, for example, you do D1, D2, D3, and then P3 is nothing but D4. D4 is nothing but D3 into 1 plus G. As of now, assume same thing for free cash flow to firm. For example, if he gives you data of 5 years, you do the forecasting of 1 year, 2 year, 3 year, 4 year and 5 year, and then 5th year terminal value would be standing. Terminal value would be 5th year cash flow. That's basically 5th, in this case 3 year. 4th would be what? FCFF of 3rd year into 1 plus G divided by KO minus G. Although this is not the correct way of doing it, I'm saying this is not the correct way. The terminal value basically depends upon a normalization of company's structure, and there is certain parameter of a normalization which, once we move in the practical side, I'll tell you what exactly it means. Second variety I'm moving is to calculate terminal value. Number, I think 40. This was question number 7. No? In this everything was given. I should have given it. 28th will I think by chance I have missed out here. I'll take it from the main book. I'll take it from 48. At question number 48. You will not have this question with you. Briefly wrote with you. Give you a hint of it. It says Yes Limited wants to acquire No Limited, and cash flows of Yes Limited and merged entity are given below. Year 1, 2, 3, 4, 5. Yes Limited for 5 years and merged entity for how many years? 5 years. Only objective is to just to see a terminal value. Rest question will not do it. In this case, he says since forecasted cash flows are given for how many years? 5 years. Earnings would have witnessed 5% growth after earnings would have witnessed 5% constant growth rate without merger. That means Yes Limited terminal value would be based at what rate? 5%, and 6% they'll be growing at what? In the merged case. So my first part in this type of question remains is when we calculate this type of a question, the first part, this is for 40. The first part will remain is calculation of a terminal value. Since I had a 5-year cash flows, we'll do it's a 5th year cash flow into 1 plus G divided by KO minus G, and in the case of the merged entity we'll be using 6%, and then our question becomes normal. It's a 1 year, 2 year, 3 year, 4 year, 5th year and 6th year terminal value. That's the second variety of a question which comes out. So I'll be doing it anyhow. That's the reason of showing is because there could be a possibility one way he'll ask you calculate terminal value this way. Second way, terminal value correctly would be calculated some other way which will come back. Now one question I can calculate based on the terminal value, or you can say a lump sum value, is question number 41. Just 41 is there here. 41 question number will come back. I think that should be there. Yes, that's there. No? That's an important question. (41). That's an important question for the exam. It says the valuation of a Hansel Limited has been done by investment analyst based on expected free cash flow of 54 lakh. The words are expected free cash flow of 64 lakh for the following year and expected growth rate of 9%. The analyst has estimated value of Hansel Limited to be around 1800 lakh. Basically, you know what he would have done? He would have done free value of firm is equal to the free cash flow, that's as good as D1 divided by KO minus G or K minus G, depending on whether he has given debt equity both or not. This line I cannot forget ever since this question came in exam. However, he committed a mistake of using the book value of debt and equity. Just 2 years before, I train lot of equity sites. So during that time, I remember when this question came 2 years before, one of my students went for the interview. Not from this round. I was taking iBanking course in the valuation side. This is exactly what you're doing now. The same course we can have 2-day seminars, DCF analysis we call it as, practically done, or there could be a iBanking, or some of the institutes have M&A courses, and the company with which I used to work, there was a valuation arm for the purpose of training. So I remember this line when came, I could not imagine to ignore it. In practical life, when you calculate KO is cost of equity into weight of equity plus cost of debt into weight of debt. He was asked exactly same thing, that KO is based on book value weights or market value weights. He said book value weights, and interview was over then and there. There was no other question asked to him. The KO is based on the market value weights. Problem is I cannot say it with so aggression in your classes, because in the cost of capital chapter inter, you have book value weights and market value weights both. The moment I say how, when, etc., practical life, remember, no matter what happens, if by chance you go, and especially in the valuation side of an interview, because they'll ask you the questions, how do you calculate free cash flow, why do you take free cash flow to firm, when take free cash flow to equity, these things we cannot discuss in the normal session, but they'll ask you these questions only. They'll know that you know how to put in the formula. So they'll ask you, and maybe a basic formula they'll ask you, how do you calculate the KO? KO is based on the market value, book value weights. It has to be the book value or market value weights. When this question came, I could remember that his interview was over. I think then he went into other stream of the career. Basically, he gave around 10 interviews. One of the interviews in which he was faulted only because of one question. M&A interviews or the valuation side interviews are very tough. You might have the iBanking interviews can go up to 8 to 9 rounds. Even one round, you make a mistake, almost over. Career is over. Career over means the placement is very difficult. So the same question when it came, it says he committed a mistake of using a book value weights of debt and equity. Actually, KO should have been based on book value, market value weights. What he did was, the question is saying is, he used value of firm as FCFF of 1 year divided by KO minus G. This KO, as per the question, has been used as a book value weights, but practically it should be used market value weights. Now, next paragraph tells you the book values employed by the analyst are not known, but you know that Hansel Limited has a cost of equity of 20%, post-tax cost of debt is 10%. The market value of equity is thrice its book value. The market value of equity is thrice its book value, whereas the market value of debt is 9/10 of its book value. What is the correct value of a Hansel Limited? You have to calculate the correct value of the Hansel Limited. Basic you have to do is what? You have to calculate KO based on market value weights. What you have done is calculate on the book value weights. Now what we will do is, we don't know the market value, but we know KE is known, KD post tax KD is known, and we know the weights are 3 times the market value for equity, and debt is 9/10 of the market value of book value of the debt. What we can do is, using existing data, let me calculate the wrong KO. Using existing data, let me calculate the wrong KO. What is my value of firm given? 1800 lakh. Based on free cash flow firm, how much amount? 54. KO I don't know, wrong KO also I don't know. Growth is how much? 9. Using this data, you can do KO minus 0.0954 by 1800 and then plus 0.09, you will get wrong KO. Wrong KO is equal to 12%. This is wrong. This KO is based on what? Book value weights. My KO formula I know is nothing but cost of equity into weight of equity, cost of debt into weight of debt. This I know is 12. KE I know 20. If weight of equity is X, KD is what? 10. I use 1 minus X. So what are we trying to do? Using this, I'll calculate weight of equity and weight of debt. That will be book value. Once I know the book value, then market value I can easily calculate. Then market value becomes easier for me. So using this data, I calculate 12, 20x. Sir, what is this? This is weight of equity assumed, and total weight is 100. So I can put 1 minus x. This will be, sir, 10 minus 10x, and you solve for x, you'll get some number 0.2. It means 20% weight was given to equity. Weight of equity is 20% weight. Weight of debt is 80%. Now there could be n number of ways of doing mathematics. There could be n number of ways of doing mathematics. I want to keep my life simpler, so I have my own way of doing it. What I assume, let's suppose combined book value of both of them. Combined book value of both of them was 100 lakh. Let's suppose out of that, weight of equity wrong is how much based on book value? 20. Weight of debt, the weight of debt means equity basically. This is I can put equity, and this is I can put as debt. So my debt is equal to how much? 80 lakh. I know market value is how much times? 3 times. This is my market value. This is 9 by 10, 72. So basically my combined market value is equal to 132. 132. So I can find my new KO. New KO is basically 60. It's 12% into 60 by 132 plus 10% into 72 by 132. Basically what I'll do is I'll find new KO. Using that new KO, I'll find new value of firm. We'll get 12% into 60 by 132, 10 into 72 by 132. How much do I get new KO? 10.91. If I get this as new KO, then basically can I calculate new value of firm? New value of firm would be 54 was expected, 0.1091 minus 0.09. Yeah, we have taken something wrong, I think. K is not 12, K is 20. KO, K is 20, sorry. Tell me how much do we get now? K is 20. 14.1455 with the new value of firm. 9. Basic objective was using the existing data, you find wrong KO. Using wrong KO, you find the weights. Then using that, we try to find the new weights based on market value. And once we get the weights on market value, new KO, this is correct KO. And using correct KO, expected cash flows and growth, you calculate the value. 972.97. 972. Number 40. What we have done is, I had 54 expected cash flow, valuation was given, this value was wrong. Using this data, we reverse calculated KO, KO was 12%. So assumed weight of equity as X, weight of debt would be, since 100%, 1 minus X, and weights came out, equity 20%, debt 80. Assumed book value of equity debt 100. The equity would be 20 lakh, debt would be 80. Market value would be 3 times of equity. You have 3 times of equity and debt is 9/10. Total 132. New weights, I'll have weight of equity 60 by 132, weight of debt 72 by 132. New KO I can find 14.55 or 14.54, and I can apply. Quickly check it out. Done. Now moving to the formula of FCFE and FCFF. Let me move up to the formula of FCFE and FCFF. FCFE. Let's try to recall back our cash flow statement. Indirect method. Do is net income, and net income you add back what? Plus depreciation. Then you adjust for working capital, minus either increase in working capital, or you can have something called plus increase in working capital. This is actually adjustment of called operating activity. That's operating activity. Then you adjust for investment activity, will have capital expenditure, that's investing activity. And since we are looking for FCFE, interest has already been taken care at net income level. Depreciation add back, increase decrease working capital, adjustment of operating activity, capex is investing activity, minus debt repayment, minus debt repayment, or you can have plus debt raised. Cash outflow minus cash inflow plus, that is adjusting of financing activity only with respect to the debt holders. And balance what we get is known as FCFE, free cash flow to. This will forecast for number of years, maybe 1, 2, 3, 4, whatever the number of years, and then we'll calculate terminal value. FCFE we have, and FCFE can be done the forecasting, and once you do the forecasting, then you can bring back to the 0 period value. That's FCFE formula. So it's adjustment of operating activity, investing activity, and financing activity. Non-cash item, any one of them will come, increase, decrease. He will not give both of them because we'll take the combined value. He'll not give debtors individually or the creditors individually. He'll give combined. So either increase in working capital or decrease in working capital, one of them would come. Now looking at FCFF, when we start with FCFF, free cash flow to firm, since we don't have to subtract the debt obligation and interest, we start at EBIT level. EBIT, earning before interest and tax. EBIT minus tax on EBIT will give me a term called NOPAT, net operating profit after taxes. Net operating profit after taxes. We do not subtract the interest, assuming there is no, the cash flows are left for the firm. Then you adjust exactly same way the operating activities plus depreciation minus the increase in working capital plus decrease in work. That's adjustment of operating activity minus capex. Investing activity. This will lead to FCFF, free cash flow to. Whatever data is being given to you, you'll adjust accordingly and you'll take care of the items. This will be discounted by a discount rate known as KE. This will be discounted by a discount rate known as a KO. Will be discounted by KO. The tax benefit of the interest will be taken care at KO level. There's nothing to worry on that front. So it's a firm cash flow discounting by the rate of KO. It's a equity cash flow discounting at the rate of KE. This will be done forecasting till the period question will tell you. After that, he'll give you the indication how to calculate terminal value. One way is exactly same what we have done just now, that it will be a last year cash flow into 1 plus G divided by KE or KO minus G. In case there is concept of normalized year, which generally he has been giving, then we'll see what has to be done in that scenario. That's FCFF and FCFE formula. A combination of the M&A and the capital budgeting question, we have one 28 question. Combination of capital budgeting plus the M&A valuation. Question number 28. Question number 28. XY Limited, which is specialized in manufacturing garments, is planning for expansion to handle a new contract which it expects to obtain. An investment bank has approached the company and asked whether the company has considered venture capital financing. In 2001, the company borrowed rupees 100 lakh on which interest is paid at the rate 10%. Relevant data for me, 100 lakh rupees are outstanding, 10% interest. The company shares are unquoted, unlisted, and it has decided to take your advice in regard to the calculation of the value of the company that could be used in negotiation using the following available information and forecast. First paragraph is only giving you a hint that you need to do the valuation of a company, value of equity, so that accordingly you can raise some amount, and the company already have 100 lakh of the debt which is borrowed at the rate of 10% sometime back in 2001. Then he says company's forecast turnover. Turnover is sales. Company's forecast turnover for the year 31st March 2005. Its first forecasted year is 2000 lakhs, which is mainly dependent on the ability of the company to obtain a new contract. The chance for which is 60% probability. Turnover for the following year is dependent to some extent on the outcome of the year to 31st March. Following are the estimated turnover and probabilities. Now try to understand a data, because this will help you in the capital budgeting decision tree or a probability tree, whatever we can call it as. He says in year 2005 the turnover possibility is 2000 lakh, 1500 lakh or 1200 lakh. Chances are 60, 30 and 10. Sum of the probability would always be 1. That means you will earn 2000, 60% chance, 1500, 30% chance in 2005, 1200, 10% chance. If you earn 2000, then in next year there is a possibility you'll have either 2500 or 300, that's 70% chance and 30% chance. The 2006 second data depends on depends on having this chances. This data depends on understand. It means if I want to check, sir, what is the chance or probability of this 2500? The probability of this 2500 is this 70% depends on this 60%. For example, this I'll be doing in the derivatives also. In fact, if first year I have 3 cases, 0.60, 0.30, 0.10 chances, then next year this probability is dependent on, we say, a joint probability. You know what is a joint probability? What is joint probability? What is joint probability? Any examples taken in the class should not be attached with any personal life, dead or life, or with CA or your background. Start with CA foundation. CPT world. Then comes final. 1000 students appear. Pass percentage 40, 400. Then they enter na, then enter to final 30. How many goes further? 1, and then very slightly positive nalayak 20. 40, 30, 20. What is the joint probability of a person starting here and ending? Means this 20 depends on this 30, this 30 depends on this 40. 2.4, such a high percentage. 0.4. That means out of this 1000, how many will become CA? 2.20%. Very higher side. You know what is joint probability now? Joint probability is probability of this depends on this. This probability depends on this. You are lucky enough standing here. Said no attachment with any person. Dead alive. Example was example. CPT world, they would have taught you toss a coin, 50 paisa. Chances of what? Head and tail. Second time again. Both time 0.5 into 0.5. That's called joint probability. Joint probability is happening of two events together. Probability that will be smaller. That means basically this 70 is not 70. This 70 depends on this 60. That means chance of happening is only 0.42. This 30 depends on what? 60. 30 depends on 60. Probability event happening is what? 18% chance. Because prima facie what happens, one thing is for sure, probability sum this would be 1, probability sum this would be 1, Joint probability sum also would be 1, but he has given also line. Look at this line he gave. The company's forecast turnover to the year is 2000 lakh, which is mainly dependent on the ability of the company to obtain a new contract, the chance for which is what, 60%, and turnover for the following year is dependent. Look at the wording. Turnover for the following year is dependent to some extent on the outcome of the year to 31st March 2005. I hope you are getting my point, what I am saying. That depends on this. So basically you have a joint probability. First is to calculate the turnover, which will do it, don't worry. I'll ask you to do the calculations. I expect you to do the calculation, please, otherwise I am talking anyhow. Operating cost inclusive of depreciation are expected to be 40 and 35% of turnover respectively for the years 31st March 2005 and 31st March 2000. That means once you calculate the revenue, then automatically you can calculate the operating cost. Tax is to be at 30%. This is the most important line and which makes your life simpler. It is assumed that profit after interest and taxes are free cash flows. PAT level is never a free cash flow, but question says, question is a god, you have to assume that he is right. Whatever he says is perfectly fine. It is assumed profit after tax, interest and taxes are free cash flows, and growth in earnings is expected to be 40% for 7, 8, 9, which will fall to 10% each year after that. It is not fall by 10%, fall to. Stagnant growth is 10%. Industry average cost of equity is 15%. What is net of tax? I have no idea. It's a 15% KE. Basically what you have now is, for 2005 and 6, he has asked you the concept of joint probability, calculation of the revenue. For 5 and 6, you calculate revenue. Based on 5 and 6, then minus the operating expenses, minus the interest cost, you get EBT, minus the tax, you get PAT. PAT is assumed as the free cash flow. For 5, 6, calculate the free cash flow. 7th, 8th and 9th free cash flow. 2007 cash flow is dependent on 2006. 8 will be on 7, 9 will be on the 8. You get for 5, 6, 7, 8, 5-year free cash flows. And then after that he says assume what? Terminal value, constant growth of what? 10%. Discount back and get the value of the equity. Sir, will you get the value of the firm or equity? It's a equity because you're calculating equity cash flows. The moment you subtract the interest, it means cash flows are equity only. The equity cash flows, the value of the equity would come. Let's calculate and see the answer. I'll ask you to do the calculation on the calculator. Get comfortable level of the probabilities because we'll be using in derivatives to some extent, and the capital busting also. I think this would come. 28 joint probability. The first part we are doing is, I'll be slightly slower in the calculation of the revenues. 26th question, calculation of revenue. Standing here 60, 30, 10, 2005 and 2006. 2005 and that's exactly what we are looking at. That's only the slide. It says you have been given 22,000, 1,500 and 1,200. Next year would be 2,500 or 3,000, 1,000 or 1,800, 1,500 or 1,200. This 70% depends on this 60. So joint probability is 42. 30% depends on this 60. Probability is 18. Internally when you will add back, you will get same numbers as 1. The sum of the probability would always be 1. In fact, probability will come very handy in the portfolio also. Sum would be 1. The probability of happening this 2000 is 15% chance only. The probability of happening this 1800 is 15% chance. Happening of this 1500 is 6% chance. Happening of this 1200 is 4%, which comes up. Now how do I calculate, sir, the probable revenue? Probable revenue is for 2005 is 2000 into 60%, 1500 into 30%, 1200 into 10%. You'll get revenue for 2005. How much do we get? 1770. For the next part, when you calculate the probable revenue, it will be 2500 into 42. I'll use in color. 2500 into 42, 3000 into 18, 2000 into 15%, 1800 into 1500 into 6%, 1200 into 4%. Actually, when you are doing in this revision class now, try as if you are revising and how faster calculators can move. Only test on the calculator skill, that's it. If you are good at the calculations, that means you are able to make out what is happening. So I can calculate revenue for 2005 and 6. For 2005, I think actually slides when I do in the class, so I have perfect way of doing it. Here is 2005, that's second part. 2005 revenue I get is as 1770, and 2006 revenue would be 2298 lakh. I hope by now you would have realized how to bifurcate the slide. Slides can be sometimes three parts. Division is there generally. Calculation of FCFE for 5 and 6 revenue, operating expenses 40% and 35%. Interest, sir, came from where? First paragraph he gave. It is an assumption that 100 lakh debt is as it is as 100 lakh. Some clarity institute has to give. If it does not give, I have assumed 100 lakh debt is standing as a 100 lakh only. EBT we get, tax you subtract, you get what? FCFE. This is actually a PAT. Question said it will be assumed as what? FCFE. And then you can do the calculation. Once you calculate this, then you can do for 2007 he said 40% growth, 2008 he said 40% growth, 2009 he said 40% growth. I can calculate these my forecasted. And terminal value, or I can say value from the end 9th year standing 2009 till infinite, will be 9th year FCFE into 1 plus G divided by KE minus G. This I get, and then I discount back at 15%. Quickly check the numbers, please. Check the numbers. Forecasting of the revenue, then based on that forecasting of revenue, you calculate the PAT or FCFE. Based on that FCFE, you calculate for 7, 8, 9, 40% growth, and then terminal value. Done. Next question is perfectly made, framed by an institute exactly how practically we do the valuation. Now the parameter of calculation of terminal value would change. We call that as a normalized year. 43. Question number 4343. Following information is given in respect of WXY, which is expected to grow at a rate of 20% per annum for next 3 years, after which growth rate will stabilize at 8% per annum normal level in perpetuity for the year ended 31st March 2014. So data has been available till 31st March 2014. Revenues given, cost of goods sold, operating expenses, depreciation included in COGS and operating expenses. That means if you subtract revenue minus COGS minus operating expense, you will reach at EBIT level, not EBITDA, you will reach at EBIT level. Depreciation, capital expenditure is given as what? 750. Depreciation is given as 600. Now next part he says, during the high growth period, revenue and EBIT will grow at what rate? 20%. Capital expenditure net of depreciation. This line he only gives. Now actually your institute every time gives this kind of a line. Capital expenditure net of depreciation will grow at 15%. Our objective is, when I calculate my free cash flows, capex is subtracted, depreciation is added. Let me do a number crunching for you so that you do not get confused. If for example I take capex minus depreciation, where do I stand? 150. If it grows at 15%, can you tell me the growth? How much it becomes? 172.5. Since capital expenditure is heavy, I'll put it as minus. Let me do separately. Depreciation individually grow 15%. 690. Capex individually grow into 1.15. 862.5. This is minus here capex and this will be plus. If you look at, I'm highlighting in yellow, 862.5, 690, the answer would come exactly same, 172.5. Although when you will learn in the practical life, you will never do capex net of depreciation. You will write capex separately, because anyone who is analyzing the statements, he want to see what is the amount of a capital expenditure they are doing and what rate or what speed that capex is going up or going down. That tells the indication of the growth story of a company, which we cannot know as of now. You'll come to know once you move into the practical side of it. So we have, during high growth period, revenue EBIT will grow at 20% per annum. So basically I can grow my revenue and EBIT at 20% and capital expenditure at 15% per annum. You can take net of them or individually. Your institute has given the line net of them, so do it net. Although in the study material I think they have given alternative also. From 4th year onwards, this is very important now, 4th year onwards, normal growth period, revenue EBIT will grow at 8%. This is the most important practical world scenario. Incremental capital expenditure will be offset by depreciation. Actually this is the indication of called a normalization year. When do we, till what year should I forecast my free cash flows? 1 year, 2 year, 3 year, 4 year, 5 year, and where should I take the terminal value? The indication of the terminal value comes is your depreciation should match capex. Actually understand what happens practically is, when any business starts, any kind of a business when starts, they're starting at a very high growth. That means capital expenditure is very heavy, and then suddenly the depreciation follows, because depreciation is not 100% here. Depreciation could be a 40, 50 depending on circumstances. It follows. Then capital expenditure slows down, depreciation is still coming at same speed, and then there comes a time when depreciation capex will become equal. That becoming of equal is called a saturation year, and that is called a normalized year, from where the perpetual value of the firm would be calculated. So what happens is, I'll do my forecasting of 1, 2 and 3 years as it is. Generally what we do for the terminal value is the 3rd year cash flow into 1 plus G divided by KO minus G if firm valuation is done. But a practical life will be exactly same way. 1, 2, 3 year you draw at 20%. This is called normalized year. which will have revenue at 8, this has 8, and capital expenditure depreciation will nullify each other. This is not a fourth year value for the purpose of calculation of the discounting. This is a forecasted value based on which we'll calculate our terminal value. We call that as a normalized year. Now, why are you focusing, sir, so much on this? Two important reasons. If MCQ says what is the indication of a normalization, the indication of normalization is capex and depreciation will become equal. That's one part. Second is when you go into the practical life, in interview says how do you decide where would you normalize or when would you normalize. Actually, every analyst who doing basically a saturation year or terminal value will make sure the year on which terminal value is calculated, the depreciation would be same as what? Capex. That is the indication what is there. Since you have a MCQ, I don't know what kind of MCQ they can ask. Any teacher who has a slight knowledge of it will frame the question, because this is the most important part, and which your institute recently has started is focusing a lot on these type of questions. Normalization. So generally, actually we are in tendency, the terminal value is last year cash flow into 1 plus G, last year equity into 1 plus G. It is not, it is a normalized year. That normalized year is actually a forecasted year only, with a change of depreciation capex becoming same. In this it says the incremental capital expenditure will be offset by depreciation. During both high growth and normal growth period, net working capital will be 25% of revenue. This will help in calculation of increase or decrease in working capital. So revenue was not important. For me, the important was because he is using a weighted average cost of capital, income tax rate 30%, and very interestingly, he has correctly used the word free cash flow to firm and WACC methodology. That means firm calculation is EBIT minus tax. It's a NOPAT. NOPAT is net operating profit after taxes plus depreciation, which we know, or we can take capex minus depreciation as 1. Change in working capital would be important. Revenue was not important, but because my working capital is based on revenue, I'll have to forecast my revenue. So my indication would be what? I need a free cash flow to the firm. He has given very clearly in the line free cash flow to the firm. Since I need a free cash flow to the firm, I need EBIT. EBIT I can calculate historical is 7500 minus 3000 minus 2250. That will grow at what rate? 20% for 1 to 3 years. Normalized year would be a 8% growth. Then I calculate my revenue of 1 to 3 and normalized year, and my working capital will be based on my revenue. And then I can put in my format normalized year calculation I will do for the purpose of calculation of the terminal value, and then you can do the discounting. The rates are available to you. The rates are given here. Using these rates, since he has given 4 decimals, use 4 decimals and calculate the present value. Let's look at the answer. Just cross check your numbers. Important is checking your numbers. Oh, 48 was question, answer was available, question was not there. Question was not there, na? 48. Okay, you can avoid this. Which question are we doing now? 40? 43. Calculation of EBIT. Revenue minus COGS gives me EBT. I'll just show you, then I'll give you 2-3 minutes time to do the check the calculation. Look up please. Estimation of revenue, EBIT, working capital, 1 to 3 years, normalized year. So I have shown exactly the way I calculate. It's 20% growth into 1.2 is 20% growth, 20% growth, 20%, and then 8% growth. EBIT 2250, 20, 20, 20, and 8%. Working capital is 25% of the revenue. Then use EBIT is starting here. EBIT 1 to 3 normalized year, tax on EBIT, NOPAT, increase in working capital. Historic working capital was 7500. That's based on this 7500 into 25, and then basically what we'll do is, since it becomes 2250, the old working capital was 1875, increase will come 375, and second would be 2250 to 2700, then 27 to this, and then this to this will give you the working capital increase. Capex I have taken net of depreciation. If you want to show separately, it's up to you. It's 150 plus growth of what percentage into 1.15 in this. Last year was important, normalized year will be nothing. Now once you calculate, this is actually a forecasted year. Do not add any kind of a growth etc., because it has been already grown at 8%. Now you cannot do the argument, sir, can't we do Some students say, sir, can't we do this into 1 plus 8? No, you cannot do, because the depreciation capex is what? Same. So you cannot apply the third year into 1 plus G formula. So that is a change which has come here. It becomes a normalized year. Based on this, calculate the terminal value, and once you calculate terminal value, then you calculate value from. The question is simpler, much simpler, and beautifully framed without any kind of a wrong calculations. So this is the best question they can make on the valuation. I'll add something more to it, some beta concept. Quickly go through it, please. Quickly go through it. Check the question data. Revenue forecasting. Based on revenue, it's a working capital forecasting. EBITB anyhow required. Check the numbers quickly, please. Done. Another part he can add with this is some beta concept, calculation of KE and KO, etc. Let me look at that framework. In fact, I've given you 83rd question. I think that you can try as a homework. Let me cover something from different material. Third becomes easier for you. Eighty-third, I'll ask you to try on your own. Before that, let me work out with you another number, please. This question is not with you. Don't worry. You have similar 83. So I'll discuss one, and then one you can try at home. Look at the numbers. Following information available in respect of XYZ. expected to grow at a rate of higher rate for 4 years, after which growth rate will stabilize at lower rate. Information is given: revenue, EBIT, capex and depreciation. Information for high growth and stable growth period is given. Two periods are given to you: high growth, stable growth. The high growth period, he says, will grow at 20% and stable growth 10%. Then he says growth in capital expenditure, depreciation 20, and this he says capital expenditure are offset by depreciation. That's the indication of normalization. Then we have a risk free 10 and 9, equity betas, market risk premium, MRP, pre-tax is pre-tax is interest rate. You'll have to calculate post tax. Debt equity 1:1, debt equity 2:3. For all time, working capital is 25% of revenue, corporate tax rate is 30. Value of the firm you have to calculate. Now, using this data, since debt equity is available, we'll calculate FC, FF. Now, first we'll do two things we need: free cash flow to firm, discount rate, KO. Now, for KO, two periods are available. Let us first calculate the two different KOs. Two different KOs we have to find, because, sir, whenever, why he has given this risk free? Whenever he'll give you risk free, equity beta, and this, that means he wants you to apply CAPM, RF plus beta into RM minus RF for the KE calculation, and KO would be pre-tax is given, multiply into tax rate 1 minus T. That means basically 13 after tax would be the KD would come, and the KD MRP is what, sir? MRP is nothing but RM minus RF. RM minus RF would come. So let's first find, tell me the KE, how much KE do you get high growth period? Just roughly do it so that I can show you, and then you can try that question number 83 at home. How much? 16.9. Or do me a favor, 16.9 KE you are saying. I'm just writing, we'll see it together. 16.9 KD. KD is 9.1 and debt equity 1:1. So can we find KO? KO, high growth. How much? 13. I'm assuming your numbers are right. Let me see once. Yes. So high growth period we have 16.9, 9.1, 13%. Was KO na? Now we find, same do the exercise for me. Just try roughly so that you get confidence of solving the question also, please. The stable growth period. Stable growth period, sir, using 9%, 5 and 1%. Let me find KE. 14. KD. 9.9%, 9.002, 9%. 2:3 KO. So why do we need KO for stable growth? Terminal value. How much do we get? 12, 11, 12%. I'll not write, I'll see. Why do I get 12? Why did you get 11? What is the figure? Acha, opposite. The weight, heavy weight is always a problem. Ask me, Nalaik. Now understand the problem here. The moment you make a change here, na, subsequently everything will fall out of the course. Step, although this is the last step, because you will be able to calculate revenue, etc. But try to be slightly careful. 12%. Now let's do one thing. Help me out with the numbers roughly. Revenue will grow for how many years? You can put down in the sheet roughly so that you know we're doing how many years? 4 years, na? So calculate 1, 2, 3, 4 and then normalize the year. calculate the numbers 1, 2, 3, 4 so that we can cross check the numbers also. 1, calculate revenue, calculate EBIT, calculate working capital, and capital net of depreciation you can show, since I might have shown that. Once you calculate, let me know, I'll see my numbers. So how much growth we have? 20% growth, and then it will be stable, would be normalized, would be 10%. And he said working capital is 25% of revenue. Let's check number by number, and then I'll ask you to calculate free cash flow also. So calculate such a way that you can calculate free cash flows also. Once you've done, let me know. Can I see my revenue numbers? Let me see that this calculation. I stand at revenue numbers are 2400, 2880, 3456, 4147.2, and normalized it 4561.92. EBIT 360, 432, 518.4, 622.08, 84.29. And working capital is 600, 720. This is, I think, one of the examination or RTP question, maybe study material. I'm not recall from where I have taken this. 720, 864, 1036.8, and this existing working capital based on this. Now you have calculate the EBIT, the FCFF calculation. I'll show you one more thing. Its capex depreciation is 280 and 200. 80 you can take, and then accordingly grow 20. I'm standing here. If anyone has not seen these numbers, then I'll see your FCFF numbers, please. You have a EBIT available. You can minus tax. Tax was what rate, sir? Tax was 30%. Tax is 30. No PAT. Working capital you can take from here. There is no challenge. And capex minus depreciation you can show separately, or take 280 minus 200. 80 growth, 20% every year for 4 years, and then calculate the FCFF. Once you've done FCFF, let me know. I'll see my answer also. Can you show depreciation once again? Capex 280, depreciation 2, tax rate 30%. Can I see FCFF calculation? Let me see my FCF. Check your numbers, please. Try the numbers, assuming as if you are doing independent exercise. Terminal value and then calculate value of firm. Basically, stable growth or terminal value is based on the stable KO 12%, and discounting would be done at some other rate, 0 period. Let me check the number. Value of firm. Done? Check the numbers, please. Done? Based on same concept, I think 83rd is same. Just check once. 83rd the same. On the similar lines. Let's come to question number 34. An off-track question based 34. Now before we do 34th, let me put down something very different. We have just now done what? We have done these two formulas. Free cash flow to firm and free cash flow to equity. Now if you look at the free cash flow to equity, it's net income, operating activity, just capex and debt. That's total what comes out. We are trying to do per share. Actually, one question I should have asked you, I don't know if you're asking or not. Repayment of debt is cash inflow or outflow? Cash outflow. So your FCFE reduces. When you debt raise, inflow. What happens here? FCFE increases. Means company keep raising a debt, FCFE will increase. If FCFE increases, equity value will increase. And why it is a different case for Vodafone? My question is very straightforward. Debt repayment outflow, no challenge comes. Debt raise, equity cash flow increases. Since equity cash flow increases, free cash flow increases. The free cash flow increases, value of equity increases. Every company should be doing the same thing then. Done cash flow statement. Cash flow statement, indirect method. Very good. Exactly you do similar way. Net income, adjust for working capital. Why do you adjust for working capital? Let me put in different way. There are two methods you might have done in accountancy. This is my income statement. So our sales here, 1000 crores, let's suppose. Then there are some expenses. Then you get net profit. From this net profit you start, and then there is a balance sheet. By looking at this net profit, no one can tell how much sales were cash or how much sales was credit. But when you look at the debtors, let's suppose debtors were 100 crores and they became 150 crores. Indirectly you know sales has happened. 50 crore is what sale? Non-cash. Because if debtors are increasing, non-cash. Increase in current asset is outflow, inflow? Outflow. Increase in working capital. Money is getting blocked, na? It's outflow. It's not actually outflow. What it is doing is, when you subtract here increase in working capital, you are nullifying the impact of credit sales. I hope you are able to make a sense what you do. There could be some purchases also. In purchases, when you've not paid, you adjust for creditors accordingly. Basically, whatever adjustments you do here, you are trying to adjust for your non-cash effects of here. In direct method, what you do, you only take cash, 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 so there is no adjustment comes out. That is cash flow statement. Now come to the FM part. I have equity share capital here, I have debt here. I raised 100 crores here, I raised 50 crores here. This money will be utilized where? Assets. There are two type of assets, either fixed assets or working capital. Fixed asset is capex, working capital is this. Now let me put it in different way. When I was making my free cash flow to firm, let's suppose there was 150 amount I raised from equity and debt both. I did not write here this money is only from equity. I'm talking about working capital and capex. Is it money from equity or debt? If I only take equity amount, then there is no need to adjust for this debt. Basically what is happening is it, let's suppose we invested everything in the capex. I was assuming everything you invested in the capex. You did 150 crore of what? Capital expenditure. Out of 150 crore, if I look at my balance sheet, I come to know from where is my balance sheet now, right? From my balance sheet I come to know equity capital is how much? 100. I should have taken only cash flow what? 100. But while writing my formula, the net income plus depreciation, working capital, capex, I took 150 complete. So there was 50 crore came from where? Debt. The moment I write 50 crore debt raised here, this will nullify my what impact? The capex impact. Understand what I'm saying? You subtracted 150, whereas equity money was only what? 100. The moment you adjust 50 here, that will get the impact nullified. I hope you are getting my point what I'm saying. Objective is whether you do anyhow, your objective should be taking only equity cash flows. It is not that if this was the case now, if you keep raising money from the debt, every company would be secondly raising debt only. General person also would be raising debt only. It's a equity cash flow increases. It's not. It's actually nullifying the impact which is on the top. The question which was framed, why I spoke about this is the question, one of the questions which came in your exam is dependent on, it says per share data you take only with respect to equity. So when you multiply with weight of equity, you get free cash flows only with respect to equity. So one part is that. I'll come out that question, don't worry. 34th question will be talking about. Second important part is, in that question will come is, let's suppose I did 150 lakh as a capex. The capital expenditure is 150 lakh as a total, and number of share outstanding are 10 lakh. What is the capital expenditure per share? If total capex is 150 lakh and there are 10 lakh share outstanding, what is capital expenditure per share? It is, for example, this is only I'm taking, this is 150 lakh now, I invested in capex. So I say per share, what is my capex? 15 rupees. That 15 rupees per share does not mean it's only of equity. That includes equity and debt both. So if I multiply with weight of equity, I'll get nullify the effect of debt. That's in a single data point. Either way, if you have full data, then you completely write everything. The debt raised or repayment will automatically take care of the top part. So if question comes per share, multiply EPS, for example, instead of net income I'll take EPS. Depreciation I'll take only with respect to equity. Capex I'll take only with respect to equity. Working capital I'll take only with respect to equity. That means I'll multiply with the weight of equity and take it. If that question comes, it's okay. Otherwise, this question I have not seen any interviewer asking any time that why do we raise debt. But I don't know why. If I would be there, I would be asking certainly that raising of a debt, that means you keep increasing money for equity holders. It's not so. It's only basically they're nullifying the mathematical impact which has come on the numerator or denominator. Now let's read question number 34. 34th question. Look at the question now. It says, calculate the value of equity share from the following information. You have profit of the company 290 crores, the capital 1300 crores. Now when we take this number and par value is 40, using these two data, can I calculate the number of equity shares? How much do we get? 32.5 crores. and using 32.5 and 290 crores, can I calculate the EPS? How much? 8.9. Debt ratio of the company, debt is nothing but debt by equity. This is debt ratio is debt by capital employed. Weight of debt is 27%. It means weight of equity would be, long term growth rate G is available, beta 0.1, risk free 8.7, market return RM is this. Whenever you have this kind of data, apply KPM to calculate KE. Apply KPM to calculate KE. 8 point. Actually, when you are calculating KPM now, keep in mind, if your beta is lower, the return would be near to risk free. Actually, your return is coming 8.86 and risk free rate is how much? 8.7, because your beta is very less. Zero beta means risk free beta. If the beta increases, automatically KPM return would be higher. So somehow keep open mind so that you know that my numbers are on the right track, knowingly or unknowingly. Since my beta was very less, your return is coming near to the risk free. Now capital expenditure, it's per share. It does not mean it's only of equity, per share. If I want to calculate only of equity, I'll multiply by weight of equity 0.73. How much do I get? Capex 34.31. This is minus depreciation per share. For equity, I multiply weight of equity 28.47. Working capital, nothing is said, it's assumed increase in working capital only into 0.73. When I multiply, I'll get per share 2.52. Now formula you apply is net income change in working capital, so I can use my EPS minus increase in working capital per share data we are taking, plus depreciation only of equity minus capex only of equity. So nothing of the debt would come. 8.92. This will give me, sir, what we need to calculate. He said calculate value of equity share. Using this data, I'll calculate increase in working capital is 2.52 negative. Depreciation is 28.7. Capex is 34 point. This will give me FCFE per share. FCFE per, get some number, 5.56, 564.56. So if I calculate my share price, it will be 0.56 into 1 plus G 1.08 divided by KE 0.0886 minus 70.5, 70 point something would come. 70 point. 70.33. Done. Go back and check. Number. Thirtieth slide number. Slide number 3030. Just take 34th slide number, please. That's per share. Done? How many questions are left in this slide? You have? At the last, if you have someone in a slide thing, the handout PDF. Similar question, na? That will be a homework basically. You can try this. Now, one question, I don't know why it is suddenly struck. Something which has happened in the last 2-3 years, I think examiner can frame a question which is not, I missed out to give you in your handouts. So from my book, before I show, or let me show you. The question is not tough, but the moment it will come for the first time, you might find a challenging part. And I'm saying it again, any paper setter who is keeping track of the markets will set the paper from the current trend only. I'll do some beautification, don't worry. You don't have this question, don't worry. 76th question I am working on. Question is not tough, nothing is there. The question is actually of a restructuring. And if I'm reading feeling well or bhavana well of the paper setter, never know when the luck works. There could be a very high chance this kind of question would come. Actually, this question talks about restructure. Look at the word. And why am I talking about this? Let me show you something practically. Any discussion done in the class is for educational purpose. No share is sell or buy advice. How do you actually come to know that how should we track the companies or how do we read out? It's not rocket science that I suddenly wake up and comes to mind, oh, today we'll do this research, today we'll do. It's the prices, if they are moving, they reflect something. Let's suppose I went to Google and I wanted to see why Suzlon has moved from 5 to 50 rupees. Something would have happened. Suzlon, the English, very good. English is okay. Restructuring. Now look at this. The company went in for debt restructuring in 2020 when lenders took a haircut of 62%. It owed to SBI-led consortium, blah blah blah. Something happens and something. Go back and read what does it mean. When we'll do the question, you'll understand this meaning of this. That means something has happened. I wish Vodafone Idea same thing happens. My number would be saved. Only number. Nothing. I like laughing. Numbers would be saved. I've recharged also yesterday full year. I was actually trying to book a gas connection. 3 days it's saying server not unavailable. I forgot that phone has not been recharged. But after the board meeting announcement, I have recharged my Idea phone. Similar thing, another company, this is one company which comes in mind. Second company which was actually why I am taking these names only, there could be a number of companies. This company used to be one of the favorite companies of 2007-8 era, I am saying. And people got stuck. Anyone, if you go back and ask your parents if they would have taken, they'll never come back to the share market again. This company was one of them. Second company which has HC. Yes Bank is yet to move, so basically yes, that also was saved by them. HCC construction completes debt resolution plan. And when you go back home, just try to read. Because I have a scarcity of time, I'm just showing you. It's not that examiner will not frame. If he is not framing from the current scenario question paper, that means he is basically checking your theoretical knowledge. Nothing happens. So the question which I'm taking up exactly the same way. Keep and track of Vodafone Idea for sure, only for your educational purpose. I'm saying why? Because it is not that if Suzlon something happened, if HCC something happened, if something would happen in any other group, maybe JP Associates or etc., anything which would have happened will not happen with Idea. If Idea also happen, it's not so that it will not happen with anyone else. If you know the history, you know when a debt restructuring goes, a revival of a company happens, there could be a very high chance you never know what price it can reach. One of the companies, if you want, if you give me a time, it's okay. Otherwise, we'll It has moved almost, I think, more than 200 times in the last 2 years. Restructuring. It's okay. Come back. We'll come back. We'll come back to it. It's okay. Something gives a pain, so I cannot discuss in the class. Pain is you buy and you sell cheaply. Nishan Limited. The restructuring. Why restructuring is important? And now it will not happen that tomorrow you go, market opens, Vodafone Idea buy, 27 is the board meeting and they do not decide anything and it comes back to 10 rupees. And then you say, what nalai class we attended. It was better off without the class. Any discussion done is only for educational purpose because it's a habit only. What is a successful, you speak about them. If debt restructuring does not happen, that does not happen. My objective is only to show you how the framing of the question will take place. And does restructuring actually changes the financial statements or not? This question will tell you. It's a very straightforward small question. Nishan Limited, you do not have this, do not worry. I'll just read out this entire question I have. Nishan Limited has 35,000 shares of equity with a book value of 20 per share. It owes debt of 15 lakh, interest rate of 12%. That's existing data. Selected financial results are as follows. Income, cash flows, EBIT, interest is very heavy because 15 lakh into 12% is how much interest? 1 lakh 80. And EBT negative, EAT negative, depreciation you have, principal payment 75 and cash flow is negative. Right side, sir, 15 lakh is capital, 7 lakh equity. How he has calculated? Maybe 35 lakh into 20 book value. Restructure the financial line items showing assuming composition in which creditors agree to convert 2/3 of their debt into what? Equity at book value. Now that means out of this, ultimately, sir, what is the advantage? They might not have advantage, but the thing is, if company goes a bankrupt, the full money is gone. If by chance I say it's okay, I give you the chance, because let's suppose you are not saving one company, automatically loss will take place. For example, Vodafone Idea, it comes to me because of the number only, don't worry. 2 lakh crore of a debt is outstanding, and if you go back and try to read that number, 2 lakh or 2 lakh 20,000 crore, out of that actual bank loan is very less. It's a government dues, government dues, government dues. If that company becomes a bankrupt, let's say, the dues will anyhow not come. The government is trying to help. Some promoters have to show the interest. And I told you telecom sector is one thing because entry is a barrier. No one can come so easily. You need a network. So, and somehow the rest of the players are also very smart. Only 2 players are there. They are not letting the price increase. The moment price increases, it will get a lifeline. Price increase means and hope the elections get over and then you see the changes. Now I think the rest 2 players will have to assume that this 3rd player will stay. If they assume, then the prices will start increasing. India is the cheapest in the rates as of now, I think, in the telecom sector, and that is only because of players you know. So they are not letting. It's one phase. I am good enough, I will not let you breathe. So the moment I want to become rich, I know that you will also become rich. That's complex there, but government is trying to save that because 3-player economy should be there. If 3 players are not there, then will be a monopoly. Then they can do anything which is there. So same way, the lenders, government was a lender there. The government's lender says that he'll take away what? Agree to 2/3 of debt into equity. That means out of this, how much will convert? 10 lakh they'll take away. 10 lakh divide by 20. How many new shares? 50,000. 50,000 shares they'll take. That means this debt will be reducing to what level? 5 lakh, and this equity will increase to 17 lakh. Equity value, total number of shares would be 35 plus 50. Then he says, assume Nishan will pay tax at the rate of 15. After the restructuring, principal repayments are reduced proportionately with the debt. That means new principal payment will come how much? 2/3 debt is reducing now. So it will be 25,000 only. Who will control the company and by how big margin after the restructuring? Any change in the EBIT? No, I have shown it here, some numbers. No change in EBIT. Interest component will reduce 5 lakh into 12, 60,000. The EBT would be 20. Tax at the rate, PAT 17. Depreciation 50. Principal this, and you can imagine cash flow comes what? Suddenly, what was a negative cash flow company becomes what? A positive cash flow company. So it's not that price will keep increasing or there are bogus companies somehow. There is something which a general layman might not understand. There are big players who understand. Rising valuation is right or wrong, that I do not know. But after restructuring, this will get a lifeline. That's exactly what happened. So he wanted to check cash flow will be there, and then something he asked, who will be a shareholder. That means both the parties are now gaining, because if I get equity share, although my debt did not come, if I would have forced them, debt anyhow would not have come. But somehow now things can be manageable. So that's one thing which strikes me. One more question which is off track, which I think to try in this, that also you would not have. I'll just help you out. In your respective books you will have, don't worry, which is slightly weird on the maximum and minimum exchange ratio. Slightly weird question was asked some time back. This I'll quickly. Just help me out one part. You know price earning ratio? How do you calculate price earning ratio? P ratio is equal to price by EPS na. If I multiply both numerator and denominator by share outstanding, if I multiply market cap by total earning, that means there could be another formula for P ratio, market cap by net income. Practically people use that ratio also. Now coming back to this question, what I was telling you, this question would be there in your respective books. You can go back and check. I'll just tell you why this can be important, because slightly different way of solving this question. It says C Limited and D Limited are contemplating in a merger deal in which C Limited will acquire D Limited and relevant information of the firm are available. Total earning of C Limited, D Limited is given to you. D Limited and C Limited is available to you. Number of share outstanding, earning per share, price earning ratio, market price. First part he says is what is the maximum exchange ratio acceptable to the shareholder of C Limited. Now two things remained in remember is maximum is basically how much you can go. For example, when a buyer goes to the market, he decides the maximum from his side. If I give beyond this, I would be at loss. Seller, when he is selling, any shopkeeper, he knows if I go below this, I will be at a loss. So maximum exchange ratio is from the buyer point of view, minimum will be from the seller's point of view. He says find the maximum exchange ratio acceptable to the shareholders of C Limited if the P ratio of the combined firm is 7. That's the point. If that was not there, question might not have been challenging. Calculate the P ratio of the combined firm is 7. So let me try to find out what has to be done. It means basically C Limited wants to maintain, when P ratio is given, C Limited wants to maintain its market cap. Help me out using a market price and share outstanding. Can you tell me the market cap of C Limited? 768. Now I'll just show you the data, what I have done here. I've just put the question data only. Earnings was available, this was available, 4.8 was available, 8 available, this available. I've just put the market cap, that's it. Nothing else I've put from my side. Now he want to maintain the P ratio at what level, sir? 7. So what has been done is, since no synergy was available, what I'll do is I'll calculate what would be the combined market cap. P ratio was given. So what is my EPS is given na? Can I find the earnings? Yeah, earning is given. What is my combined earning? 96 plus 30, 126. P ratio how much? 7. I just asked you a formula here. If I multiply by share outstanding and share outstanding, I get what? P ratio na. So this is earning na, denominator. If I multiply P ratio, I'll get what? Market cap. So what has been done is basically, what has been done here is I multiply the total market cap would be earning into P ratio, and who wants to maintain his number? C Limited. C Limited market cap is how much? 768. He wants, I want to maintain 768. If total market cap is 882, he'll maintain what? 768. Balance will go to whom? D. That means you can issue this much to D. Now what rate to issue? Rate will decide is, he is getting what? 768. The number of shares of C Limited will remain as 20 million only. If the number of will remain 20 million, that what would be the price? 768 divided by 20 million if I do, that will be the price of C Limited. That means whatever shares would be issued to D Limited, they will be issued at this rate. What rate comes? 38.4. 38.4 comes, and I have to give them how much maximum? 114. That means I'll issue them how many shares, sir? 2.9687. This will be my swap ratio. If, sir, it was a minimum P ratio, then who would maintain his market cap? D Limited. Second part I'll show you. Question first time when it came, actually this came a long time back also, I think, or there was an RTP and then they repeated it. So it was not tough. It's only that since we don't have a habit of multiplying P ratio with the earnings, maximum is buyer want to maintain his market cap. So the way of thinking was buyer will maintain his market cap and rest will go to the seller. The what price to issue, we have calculated accordingly. Now let me go back to the second part. Minimum exchange ratio will be from whose point of view? D, and they want to maintain a what combined? 9. Let us do it verbally, then we'll discuss it out. What is combined earning? 126 into 9. How much you will get? 1134. And what was your market cap of pre-merger D? 210. So total came minus 210. Do it. This will go to whom? C. C will get 9. 24. How many shares? C shares will remain same. 20. What will be the price? 46. That means we can reverse calculate the price. 46. And that means he would be issued shares at what price? 46. How many shares? 4.55. And I hope this can be done. When you go back, you can refer. I think this would be in the study material also. Maybe this should not be a challenging part. One was this. One is another part which should trouble you. How swap ratios we have done? Target by acquirer. This question came in 2015, I think. Yes. And that time there was a time period when the banks were merging. So I'm saying again, by some examiners have tendency, what is happening in the market, they'll create the question accordingly. In this question, rest of the question you can go back, you will have the question. The objective is, he says, calculate the ratios based on gross NPA, CRAR, market price and book value per share. Now, higher the book value, better it is. That means if you have higher the book value, you will have target by acquirer. Market price again, target by acquirer. I'll show you the numbers, actually both of them. Summary I'll show you, in fact. Let me show you the summary. Let me show you the summary fact. Please. There were bank P, it was acquirer, bank R is a target company. Objective is not the entire question, one ratio I want to discuss with you. Gross NPA, CRAR, market price, book value, face value I assumed, and then I calculated book value per share. Basically, ratio was based on 4 numbers. The numbers are, he said, you have to calculate the swap ratio based on gross NPA, based on CRAR, capital adequacy ratio or CAR, market price and book value per share. If I go to the numbers here, if I try to calculate the numbers here, that means my swap ratio should be based on gross NPA, CAR, market price and book value per share. So when you use the, it's a, which is acquired, sir, I always put acquired first and target second. This will be 15 divided by 120. In market price it will be 8 divided by 128. If you calculate, you do 15 by 120, what does it mean? That means issue 0.125 share, and it is but obvious because his value is 0.15 and you are getting a share worth rupees 120. If you use the market price 8 by 128, swap ratio would be 0.62, small number would be there. If you use the capital adequacy ratio 4 by 16, that means 0.25, because yours, the target company R is very bad and the bank P is good enough. The moment you look at this gross NPA 40 by 8, something weird comes, means your loss is 5 or 8, almost 8 times. How can you issue the shares 8 times? So in this case, swap ratio would change. Please look at this. This cannot happen. That means when you're calculating something on gross NPA, the swap ratio would be what? Acquired by target. Please understand what I'm saying. The book value higher was better, EPS higher was better. Then you have what? Market price, higher was better. So you can have target by acquirer, you can frame the question accordingly. When you are making question, it's not necessary that you have to learn the swap ratio. What is the objective of these ratios? When I say 0.125:1, it means since my price is 15, I'll surrender and I'll get a share worth rupees 120, but obvious lower number has to come. 8 rupees my price, your rupees is 128, so you'll issue me only 0.0625. If my gross NPA is 40, yours is 5, why would you issue me the 8 times? It has to be the reverse calculation. So basically when you do the calculation, if you look at here, everything would be same, target by acquirer, target by acquirer, target. In this case it will change what? Acquired by target. It's based on the expense or the, keep this in the mind when it comes out, because banking changes are coming and it will keep happening next time also. When if by chance they come in, there will be possibility some more banks might merge because they want to keep consolidation of the bank. This period 2015 2016 was, or 14, after that there was a lot of consolidation happened basically in the banking sector. So this question came around that time. After that, once or twice more it has come in the exam. One question which I gave you will not discuss completely, but let's discuss brief part of it in the book. 20th number. First time I think when it came for a very heavy marks, maybe 12 or 16 higher. Next time onwards again it has repeated 20th question, but slightly lesser numbers. BA limited and DA limited. The objective is only to discuss the third part. Some data is given, BA and DA limited. Then he will ask you, assume both the companies are in the process of negotiating a merger through an exchange of equity shares. You have been asked to assist in establishing a equitable exchange terms and are required to decompose the share price of both the companies into EPS and PE ratio, and also segregate their EPS figures into ROE, intrinsic value or book value, share components, estimate growth rate. Now let's do one by one. If you look at the data which you have on the top, earning after tax is available and number of equity shares are available. Can you calculate the EPS? You can easily calculate 2.1. Market price is available. You can also calculate what? P ratio. And he is asking to calculate book value. Book value is nothing but shareholders fund, equity fund. 12 lakh, this is 8 lakh. And divide by number of shares, you will also get book value per share. Return on equity is nothing but the profit divided by equity capital. Return on equity is asking. So 2,10,000 divided by what? 12 lakh. How much you get? 70. These numbers will be able to do. Don't worry. I'm just roughly checking it out. And then growth rate would be nothing but the G is equal to B into R. Retention ratio is nothing but 1 minus dividend payout ratio. You'll get these growth numbers. Now, if you look at the data of first 2 points, I'll just summarize first 2 point data. Return on equity of BA is better, growth of BA is better, P ratio of BA is better, book value per share of BA is better. He says in this part, when you go back home, try to read out. Based on the operating synergies of BA, estimate that intrinsic value of DA could be 20 on the acquisition. He thinks value could be 20. Market price of the DA as of now is what? Based on the expected operating synergies, BA Limited estimates intrinsic value of DA can be 20 on the acquisition. His price as of now I think is what? 50. No, DA Limited. This is based on the operating synergies. BA Limited estimates that intrinsic value of DA equity share would be 20. As of now, what is 15? You are required to develop a range of justifiable equity share exchange that can be offered by BA to the shareholders of DA Limited. Full stop till here. It means what? It means is, if I look at what is the value estimation? 20. What is the share price of BA Limited? 40. So lower side, one side is 0.5:1. DA Limited will not agree any price below what? 15. So 15 by 40, 0.375:1. although we can add some more, but he is basically summarizing into two parts. It means BA Limited has share price of 40. DA Limited knows my value is 15. So on the lower side, even BA knows I'll give him 15 by 40. But BA has done some calculation and found out that value of this company should be 20. That means he knows higher side I should give what? 20 rupees. Now for one share he is ready to give upside 0.5, lower side will be 0.375. This will also will not be a problem. Problem comes in the next part. Based on your analysis in part 1 and 2, would you expect the negotiated terms to be based to closer to the upper or lower exchange ratio? Basically what it means is, I am a BA Limited, you are a DA Limited. My price is 40, your price is 15. So one swap ratio is 15 by 40. I did some calculation, I came to know your valuation becomes 20 rupees. That means on the higher side I can give you 0.5. That range I have calculated. Now after calculating range, the question want to know, you've done some working in the first and two part. Deal will take place. What do you think deal will take place on the higher exchange or lower? That means should I give you 0.5 share of mine or should I give you 0.375? If you look at the first two parts, every number of BA was better off. That means in the deal situation, BA would have a upper hand, and since acquirer will have a upper hand, he will try to negotiate the deal at what? Lower ratio. He'll try to lower. Although this is not the only way of doing it. Actually, when two people meet and they know that if someone has upper hand, automatically deal would be happening there. So question want to understand, if you look at the first two parts, if all the numbers of BA are better, that means BA will have a upper hand and BA will like to issue lesser number of shares. So they will like to issue the shares, which is, since BA has a higher EPS, ROE, P ratio, even higher EPS growth, the negotiated terms would be expected to be closer to the lower limit. So this is only a 30 seconds answer, but might not strike in the exam. And how do we decide? If my numbers were not good, whosoever has a better numbers, the deal will take place according to. That's fine. Now you can go back and do it. Let's take an energy nap here of 15 minutes. 15, 1 5, not 50, 5. Or let's try, and then we start off. Let's start. Let's come back. Small connecting chapter. I have taken it as a separate chapter, although that is not a separate chapter. EVA, it's a valuation part. Let's look at a very small part which generally question comes independently on that. EVA. We'll quickly discuss the formula, we'll finish off this and then we'll move to the bond valuation. Economic value added is a formula which is given by, there is a certain formula which is by Stern and Stewart. EVA stands is equal to NOPAT minus capital employed and WACC. In exam you'll solve the same way. Not apply any other formula, you'll apply the same formula, although I'll tell you roughly what exactly it means. NOPAT is EBIT into 1 minus T, what we have seen in the previous chapter. Capital employed is equal to equity share capital plus reserves minus fictitious, that gives you equity holders fund, plus preference share capital, and that becomes a shareholders fund impact, the shareholders fund, and then you have debt. This gives you capital employed. I've taken a small example on the slide. Taken a small example on the first slide itself. It represents as equity share capital is 10,000, reserve surplus 4,000, you have 14,000, debt is 6,000, capital employed becomes 20. KE available 20%, if EBIT is 12, tax rate 30, find EVA. If this is the data being given, how do we find EVA? EVA is equal to nothing but it's a NOPAT. NOPAT is EBIT into 1 minus T, 80, 400. Capital employed is equity share capital plus reserves plus debt 20,000. Discounted by capital employed we have got, NOPAT we have, now WACC. WACC is KO. Cost of equity into weight of equity, cost of debt into weight of debt. Cost of equity is how much percentage? 20. 20% you have into weight would be 14,000 divided by 20. KD would be 7% into 6,000. 700, how did we get 7%? 10% into what? Tax saving 1 minus T. 6 by 20, so it comes 16.1. And if you try to solve, you get EV as 5180. Technically speaking, I have not told you what EVA is, what is the meaning of it. I have just put in the formula. In exam, you will solve the same way. Now, what exactly it means is, if let's suppose institute allows me to write in the rough paragraph for rough work, I'll say EBIT is 12,000, interest is nothing but 6,000 into 10%, that gives me 600, EBT 11,400, tax at the rate 30 will give me PAT 7980. Now, this calculation everyone can do PAT. Expectation is, KE is the expectation, 14,000 rupees you have employed as a equity holder, your expectation is 20%. If you subtract the expectation from the PAT level, get EVA. But this way of solution cannot be done in the exam. If I have to define EVA, EVA is nothing but the excess return which equity holders get over and above their what? Expectation. That's basically EVA, which stands out. If a simpler question comes, there is a possibility you might cross check your answer. Calculate the PAT. Expectation is nothing but it's what equity holders have invested and how much is the return they are expecting from it. That's a EVA which comes up. So definition wise, they will not ask you. EVA is nothing but is the excess amount earned by the company over and above the expectation of what? Equity shareholders. So this is the EVA if I would have explained in the wordings term. I can cross check. Then there are a few questions which have come. Actually, some questions are very weird, which I don't know they should give or not. Some questions are something which can be tested with new kind of a scenario, which I think I might have taken a couple of them. Leverage is one thing which used to come long back. Along with the leverage, they merged the EVA concept. You used to do operating leverage, financial leverage, and what? A mind leverage. There was no preference dividend and then preference dividend. Operating leverage was because of fixed cost, so contribution by EBIT. In the second case, also contribution by EBIT. By looking at formula, everyone will say this is the ratio. If I remove this now, if I would have asked you 99%, no one is able to tell the formula once they come final. And this used to be the simplest chapter in the inter. FL is EBIT by EBT, and this is EBIT by EBT minus preference dividend divided by 1 minus T. That's basically crossing up. CL is nothing but OL into FL, OL into FL. How they will be testing it out? Let's check one of the questions. How they will be testing this in the front. Let's try question number 3. That question number. Question number 3 tells you calculate EVA from the following information. Financial leverage is 1.4, capital structure, equity share capital, reserves and surplus, 10% debentures, cost of equity, tax rate 30% available. Now when you use this data, since financial leverage is available, EVA, I need 3 things for that. I need is no PAT minus capital employed into WCC. So my working has to revolve around these things. No PAT is dependent on EBIT, so I'm not working on it as of now. The equity capital, reserve surplus and debt, if I add them up, it will become what? Capital employed. 170 plus 130 plus 400, how much? 700 lakh. 700. Then I have cost of equity is 17.5 and interest rate 1030. So KD would be equal to 7. I know the capital employed and I can calculate what? KO. So KO would be equal to 17.5 into what? 300 by plus 100 by 11.5. Now left is no PAT. No PAT depends on EBIT. I'll use the concept of FL. FL formula used to be EBIT by EBT. I don't know EBIT, neither EBT is not known. FL do I know? 1.4. I can substitute this as EBIT divided by minus in, and I know this 1.4 EBIT divided by EBIT. Interest would be equal to 400 into 10. How much? 40. 400 into 10. 40. Solve it and tell me the answer which comes. EBIT, how much do we get? 140. And then you can solve no PAT, you can calculate and accordingly answer. Check your answer, please. If you have done, then read question number 2, which has come few number of times and always one part is wrong. But you have no choice but to answer accordingly. Actually, some of you would feel these are simpler chapter we can do. I have a reverse way of thinking. I cannot tend to lose marks in these chapters. The moment I get marks in this, there is no way you will not score 60. But somehow leniency makes us so lazy that few basic things we leave while revising at home. Do not leave these chapters. Check the numbers, please. Then read question number 2. I'll discuss with you the problem in that question and which repeats itself again and again. So you cannot help it out. You have to live with that problem. Second question. Go back. Says Delta Limited. Delta Limited earned a net profit of what? 15 lakhs after tax at 40%. Interest cost charged by financial institution was 15 lakh. Invested capital is 100 lakhs, of which 60% is what? Debt. The company maintains a weighted average cost of capital of 12.6. Delta Limited earned a net profit of 15 lakh after tax at 40%. Interest cost charged by financial institution 15 lakhs. Invested capital, this required compute the operating income. Operating income is EBIT. So when net profit available, net profit divided by 1 minus T plus interest will give you what? EBIT. That will be 15 divided by 60 percentage interest. How much EBIT do you get? 40 lakh. Economic value added. No PAT would be EBIT into 1 minus T. How much? 24 minus 12 point 11 point. How do we get this? No PAT minus, I'll show you the answer, don't worry. It's no PAT. No PAT is EBIT into 1 minus T minus capital employed. Directly he has given, hence I am not doing it. Capital employed. What is debt, what is equity is irrelevant, into 12.6. This becomes 12.6. 40 minus 1 minus T is nothing but no PAT. 40 into 60 percentage is no. That's fine. Third part. Read out third part. It says Delta Limited has 2.5 lakhs outstanding. How much dividend can the company pay before the value of the entity starts? Answer given is they should not pay dividend more than EVA. You will also write in the exam same, but there is no logic why it comes. An interesting part is D part nullifies the C part. D part says if they do not pay dividend, what would happen to the value of the firm? So how can value of the firm decline only after paying more dividend than EVA, And D part says if you do not pay any dividend, the value of the firm will increase. There is no logic of the third part. In exam you write that maximum dividend which can be paid is 11.4. If you pay more than that, then will happen? Value will decline. If you pay up to 11.4, anything happens? As per the third part. Because what answer will write? If you look at the answer, you will write in same, because there are few things which you cannot help it out. Let the same way. If the company pays dividend more than EVA, value of the firm starts what? Declining. Very good. Hence the maximum amount of dividend which a company gave before the value of the firm start declining is what? This EVA. It means up till 11.4 value of firm will not decline. Then fourth part nullifies the third part. Fourth part says if it does not pay the dividend, then what will happen? Value of the firm will increase. Now, frankly speaking, Walter, which I discussed with you, was no reason of it. Whenever you have a R greater than cost, the moment you start paying a dividend, the value will have an effect. Basically, if you look at in this case, Delta Limited does not pay any dividend, value of the firm will increase because R is greater than what cost? R comes how, sir? This part, if you want to show, it's okay, otherwise perfectly fine. R is EBIT by capital employed. What is your earning rate? 40%. What is your cost? 12.6. That means ideally you should not pay any dividend. Ideally should not pay any dividend, because when you reinvest, your growth is what? Higher, which is higher. But still this part will come in the exam and you will write the same answer. Right, wrong, etc. Under the sun, when you go, you try anything, you will not get why this is the logic which comes out. Just write in the exam the same concept, that if you pay more than the EVA, the value of the firm will start declining. And the fourth part, I think, automatically nullifies the third part. So fourth part is better off, because if you do not pay dividend, since your R is greater than cost, the value of the firm will be sustaining. That means value of the firm will increase. And that goes with the logic of any kind of valuation parameter or any kind of understanding. Second question has come few number of time. It has not repeated for a long time. There could be chance that can come back. This time which question came, I think, is question number 5. Exam, this attempt question, 5th question. In the exam which came out after a long time. The following information is given for 3 companies. The following information is given for 3 companies that are identical except for their capital structure. That means debt equity would be different. Orange, grape, apple. Total invested capital, debt assets ratio you have, share outstanding, pre-tax cost of debt, cost of equity, operating income, net income. And then you have taxes uniform 35% in all the cases. Compute the weighted average cost of capital. So how do we calculate? First of all, how do we use? Using the first, you get what? Weight of debt. Can you calculate the weight of equity? Yes. Then you have KE available. So nothing but KE. These are pre-tax cost of debt. If this is pre-tax, using the tax rate, you can calculate what? Post-tax rate. Try roughly calculate. Do it for only one company. Rest will follow. Only for one company, do the data, please. What I can do is, I can do it weight of debt. Let me put weight of equity is 0.2. If this is 16%, let me put this data. 16 into 1 minus 0.35 KD. 10.4. So 10.4 is my KD. I have, sir, KD 10.4 into 0.8 and 26 into 13.52. I'm writing first answer only, 13.52. We'll do orange and rest will check. Value added for orange only will do. Do we have a EBIT available? Yes. EBIT available, no PAT we can calculate. So no PAT in this case would be how much? 16,250. Capital employed is already given 1 lakh, and WACC you calculated what? 13.2. So what I can do is 16,250 minus 13,520. Tell me the answer. 2,730. That's easy. I'm doing only for one. Which company is best? Actually, you'll calculate 3 and whichever the EV higher comes, select that out. If the industry P ratio is 11 times, estimate the share price. P ratio is available. You need to calculate what? EPS. Now, you have a net income available. Net income divided by what? Number of shares. How much do you get? Number of shares are where are given? 6100. EPS is 1.470. P ratio is what? 11 times. 11x is 11 times. You'll get the price. 16.175. And then market cap is nothing but price into. Now, if by chance some of you try using EBI to arrive at net income, answer would not tally. So don't worry about it. Since you have been given net income, do not worry. How did he calculate? I'm not bothered about it. How did he calculate? If you try EBIT minus interest, EBT minus tax, and then net income, that net income would not come same as 8970. These are normal problems in the. Not to get worried. Means paper is normal. If the problem does not come, then you assume something abnormal. That's a normal problem which comes. You have been given net income, so net income is okay. Fine. Now let's quickly cross check the number. Click cross check both the slides. Numbers you have available, just quickly go through it. I think numbers would make a sense out of it. We've discussed only the orange, no? Orange 13.52 730. And when you calculate all, you'll come to know which is the best option out. The EPS 1.4, 6.17 and market cap. Small concept when we do can be asked in the MBA. Market value added. Market value added is nothing but market value of firm minus book value of a firm. Actually, why this concept becomes important is if the market value is way higher than the book values, means the growth expectation is much higher from that company. There could be a possibility. The larger difference between price and the book value per share, it means expectation from the company would be higher, and the moment the price is higher, automatically market value would be higher. Market value firm is calculated by taking into account the market prices. The companies which have a higher MVA are perceived to be better because they might have a high growth future prospects. Plain vanilla is book values from the balance sheet, market price is the market anticipation higher would automatically give higher market value, and the perceived to be better because they might have high future growth prospects or the expectation from these companies is higher. I've just taken a small number. One question also I think I would have in the book. MVA from the following data: equity share capital, reserves and surplus, book value is 800, market price is 95. So we have market value added of the firm would be 95 into 10 lakh, 950 minus book value 800. If debt was there, I would have adjusted the debt also. It's a market value of the firm. Equity plus debt and minus also equity plus debt. So it will be both. Now let me look at data point. This has market value. Try question number 8, please. Try question number 8. You have been the following information of Messrs. DY for the year ending 31st March sales, etc. Market value of DY given corporate tax rate, risk-free rate of return, equity beta available. Calculate first the KO or WACC and then accordingly utilize. %8 is your interest rate. KD you can and you have RF available, RM available, equity beta available. Using this, can I calculate my KE? KE is coming 14%. Cost of debt would be 8 into tax rate is 30. So we get 5.6%. Then using 14% and 5.6, rate would be equity and debt. Debt is 250, equity is nothing but reserve surplus plus this, which 500 by 750, 250 by 750, 11.2. And then you have economic value added. Economic value added would be EBIT you need, na? EBIT. Now I don't know how they give it EBIT when you need. EBIT would be, he's saying including what? Interest. Actually, how can operating expenses have an interest as a operating expense? I don't know, but anyhow, they can give anything of their choice. It's operating expenses. You have to subtract the interest component, 8% into 250. How much interest? 250. 250 would be 600. This is all a theoretical world we are in. It's all theoretical world we are living in. Otherwise, there could have been a lot of changes I could have made to this. It's a 620 minus 20, 600. It comes what? 400. Less tax what? 30. No PAT is 280. Then equity share capital, capital employed. Since you are calculating capital employed, based on the book values, you calculate KO accordingly. Capital employed is 250, 250, 8%. Total capital employed. EVA comes 196. 196. Done. Second part was, one was EVA, second is the third market value. Now market value, two ways of doing it. Market value of equity is what? 900 minus what? You can do two ways. You can do this. Market value of dy is market value of equity plus debt both. It's equity plus debt both. He has not mentioned only equity. Market value is equity plus debt both minus this 750. One way of doing is market value minus what? Capital employed, book value. You get what? Market value added 150. Or you calculate only market value of equity, which is nothing but market value of equity would be 900 minus debt value what? 250. So you get what? 650. And equity, basically if you are finding here equity, you are subtracting only equity. If you write the combined value, you are minusing what? Capital employed. Frankly speaking, this sort of formula should be used in exam. Market value of the firm minus book value of the firm. Book firm, when I am using, it means debt equity both. It's a debt equity both. So it will be 150. Or you can do only market value of equity and this. This is untouched in the exam till now, I think. There could be possibility he might ask you. This is untouched area in the exam. Market value. Next question, 11th is, you'll try on your own again. Interesting question. Question number 11. You have RST Limited current financial year income statement, reported net income after tax as given as 25 lakh. Applicable corporate income tax rate is 30%. Following is the capital structure of RST at the end of current financial year, debt rate, etc. Blah blah blah. Whenever he gives you this data, it means you have to apply CAPM. Quickly try it out. Estimate KE, KD, WACC. Then reverse calculate, I think. In case you have to reverse calculate. He is given net income. EBIT into 1 minus T and then EVA. Using the first part, calculate net income 25 lakh and tax EBIT. From here I am moving below, please. 25 lakh and 30% tax EBIT, rest data. This is the important data. Above was only you have 25 lakh rupees net income and 30% tax. Using this you can easily calculate. Using this, I think, using this part, reverse calculate what? PBT or EBIT, reverse calculate, and then you have relevant data. Net income I'll write here only. Net income is and tax is equal. Done. How much EVA? 92,000. try out quickly. Done? Check the answer now. Estimated weighted average cost of capital, equity capital, KE, how much you're getting? 20.74. Cost of debt, 7.7. In this case, we get WACC 17.58. Taxable income, that's EBT. EBT is 35.71. Add back interest, you get what? EBIT. EBIT into 1 minus T, WACC minus 92,700. That's done. Just to finish off EVA. Done. Can we move? Let's start new topic. Let's start then bond valuation. Start with the bond valuation. Few terms should be very clear, although we'll be using it for the period of time. Some technical part I'll come back, maybe not today's class technical. We'll make the base work so that when we meet next time, we are at a very good position. Coupon rate is a rate at which they'll receive the interest. Yield rate or YTM is you can call it as a discounting rate, or it is the earning rate. If I stay invested in the bond till the maturity, what rate I'll earn. This is used as a discount rate. Remember the flow of the topic: 1 year, 2 year, 3 year, 4 year. You have to discount back the cash flows and get back to what? 0 period. Intrinsic value is nothing but summation of present value of interest plus present value of redemption value. Redemption value, nothing is said, you'll assume it to be a par value. If face value is not given in question, then it can be assumed anything of this number: 100,000, 10,000, 1 lakh, depending on what the rest of the data is. If let's suppose he says the market price of the bond is 99,500, face value has to be 1 lakh. If he says market value is 101, then face value assumed to be 100 rupees approximately. The only basic part. Now let us look at number 7 first. At question number 7. The intrinsic value calculation. It says Mrs. Asha Industries is planning to issue a debenture series on the following terms: face value 100, terms to maturity 10, yearly coupon rate, years rate are given. The current market rate on similar debenture is 15% per annum. The company proposes to price the issue in such a manner that it can yield 16% compound rate of return to the investor. So what does it mean? It basically means is that company wants to issue a debenture, or issue price would be such so that if investor is investing any amount, and if he stays invested, his return in hand should be equal to 16%. The company also proposes redeem the debenture at 5% premium. What is the issue price? 0 period. What is the issue price? 100. Premium redemption means 105. Determine the issue price. Now think logically, please. Basically, redemption has to happen at a premium. You will be getting coupon of 9, 10 and 14. This is the actual coupon you'll get. Practically speaking, how do you read the numbers? But let me put a bond valuation basic part to it for first, please. A basic structure should be clear so that you do not face a problem in the interest rate when it comes out. 100 rupees face value bond, 10% coupon. 10% coupon. It means how much is your bond earning? 10 rupees is your bond earning. Now, this is coupon rate is which has been promised to you and which you are getting. Yield rate is the changing rate in the market. From different perspective, let's try to think. Let's suppose the interest rate or a yield rate in the market is 8%. I am doing a very general mathematics. I am not doing any complications, which we'll do in the question so that you understand the flow of the meaning. The question, yield rate is 8. Your bond is giving how much? 10. I am ignoring any time period, 5 year, 4 year, a general basic composition. How do we read? We read you are getting 10 rupees at the rate of 10. If I go to market today, I'll be getting how much rate? 8%. I went to the market, they told me 8 and I came to know your bond is earning what? 10%. I came to you and I said, let me buy your bond, sell your bond to me at 100 rupees. You'll refuse. The reason of refusing is, you'll tell me a very simple mathematics, and the mathematics is, you'll say, sir, how much return you're getting from the market? I said 8%. You'll tell me, go and sell this bond in the market, or go and try to earn 10 rupees in the market by investing X amount at the rate of 8% such that your in hand should come 10. I'm again repeating, you'll only tell me one thing, sir, if you want to earn 10 rupees, how much amount you would invest if the rate is 8%? Tell me how much amount I'll invest. 125. If I have to earn 10 rupees, provided rate has become what? 8%. So it means is your value of 100 rupees face value bond would be 125. In economics language, we call it as, if I speak about economics, they call it as, your property is giving higher return than the market return. Your property would trade at a premium. That's a premium will trade at. Let's suppose in the market yield rate becomes 12. Your bond is giving how much return? 10. That's basically your asset is giving 10. You will be dissatisfied your asset. Selling pressure would come. Automatically, the value of your bond will be lesser than 100. Or in simple words, if I say, if someone want to earn 10 rupees and market rate is what? 12%. In general common sense, how much should he invest? To earn 10 rupees, investment at the rate of 12, how much? 83.33. That means ideally the value of this bond should be 83.33. Two principles learn from here and remember it so that you can, because when you do the complex mathematics, you might not be able to apply your brain. The fundamental principle should be, if your asset is giving more return than the market, your bond will trade at a premium. How much premium? That leave on the data. I've just used a rough numbers to understand from my perspective. Or you can say, economist will say the demand of that bond will go up. The moment demand goes up, the price will go up. Second is, if your asset is giving 10% return and I am able to get more in the market, that means your asset will have a selling pressure, or your property is giving lesser return than the market return. Yield rate is nothing but the market return. This is the market return is 12. Your asset is giving only 10% return. So it will trade at what? Discount. That's one part. Now coming back to the question again. I'll come back to the question. If you look at the language, get comfortable with the languages. Questions you'll do, I know you have habit of remembering, cramming formula, etc. Multiply, answer comes, multiply, answer comes. But able to read out the numbers also. If you invest in this bond, you will get 9% coupon, 10% and 14% rate. Years ignore. But investor, the company is planning, similar bonds are giving what return? 15. That means certainly you will not pay 100 rupees and get this return, because you want what kind of return? 15. But question further goes and says, company want to price in such a way so that you can get what? 16% return. It means company will not even take 100 rupees from you. He'll take such amount from you, so that on that amount, when you get these returns, your in hand return when converted become equal to what? 16%. Understand what I'm saying? Basically, if I use this language here, if I buy your 100 rupees bond at 83.33 and I get 10 rupees, my return in hand would be what? 12%. Similarly, company wants return in the hand of a shareholder should be what? 16. That means they will price at discount. They will price at discount, so that when you get that return of 9%, 10%, because the coupon will be same. It will come on the face value, 9 rupees, 10 rupees, 14. When you apply that with your issue price, your actual in hand return would be 16, so that you will be issued bonds at discount. Automatically pricing you will come to know. Similar case is this. If I try to say, if I buy your 100 rupees bond at 83.33, if the pricing of the 100 rupees bond is done at 83.33, assuming very general language, and I get 10 rupees, my in hand return would be equal to what? 12%. I hope you are getting the point which I am saying. In this case, you have to accordingly do it. He says the company proposes to redeem the debenture at 5% premium, determine the issue price of the debenture. Since they have 1 to 4, that means 1 to 4 I can apply the annuity. I'll get 9 rupees, 999, and then I'll get what? 10 for 3 years, then 14. Discount at the rate of 16. Sir, why discounting? Earning rate is discounting because I want to see whatever price comes. On that price, if I earn 16%, these are my cash inflows which comes out. So the answer would come as, go back, 7th. It's basically, if you look at the data here, it's year 1 to 4, 5 to 8, 9 to 10, 10th. Coupon rate is 9%, 10%, 14%. Interest would be 9, 10, 14. Redemption value 105, and total cash flow 9 for how many years? 4 years. I have applied this annuity 16% at the rate of annuity. Then this is annuity, sir, what? 1.546. This is for year 5th, 6th, 7th, 8th. The calculation is done how, sir? I calculated for 8 years, subtracted for first 4 years, and then I got this number, and then 0.49, and then 0.227. Intrinsic value comes this. Sir, how do I read this number? You read this number as, if you invest this today, and earn what? 9 rupees for 4 years, 10 rupees for 3 years, then for 2 years, and then 105, your in hand return would come as what? 16%. It would come as 16. That's mathematics. If you want to do, you can try. If you want to try out some more, invest 70. Since try quickly, please. 71.337. How much return you are expecting? Into 1.16 minus 9. First year came. Then again you are expecting what? Into 1.16 minus 9 into 1.16 minus 9 into 1.16 minus 9. 4 years gone. Then again 16 only you are expecting. Into 1.16 minus what? 10. Into 1.16 you got 10. Into 1.16 minus 10. 5th, 6th, 7th, one more. Minus 10. And then last 2 years, return is 16 expectation. Second, last 2 years minus 14. And then tell me, it should be 105 at the end of 10th year. You're getting what I'm saying? So basically, you have invested such a small amount that when these kind of a cash flows comes in your hand, they become equal to what? They give you return in hand as 16. You might wonder, sir, how it is coming? Because your investment is very less. If you would have invested 100 rupees and getting these cash flows, your return would not be 16%. I'm roughly telling you, if you go back home and try, I think if you're able to get, that's fine. Whatever amount you're investing now, whatever return you're expecting, multiply, then receive cash flow, then return, receive cash flow. At the end, value would come 105 only. That means your return in hand would be 16. The objective is not to tell you the return or a mathematics. Objective is, this chapter is slightly complicated. It has become in the recent years. Otherwise, 70-80% of the chapter, By numbers I can make out that what number will come. Will my price will come higher than the given price face value? Will it come lesser than the face value? Will my yield rate would be higher than the coupon? Will my yield rate would be lesser than the coupon? So you should be able to work out. The working out would be if you are expecting a more return and coupon are less, that means your expectation is more, coupon is less, this will be at a discount. Which this is first of the question which came recently also, it came long time back in the exam. Another type of a question is the replacement. Let me try 23rd. Based on the credit rating of bonds, let me do small exercise with you before I do this. I did not take smaller questions that you would know. Since you would know, let me take smaller exercise so that you get basics right. Wait for a minute. Bond valuation. It's look at this question. Don't worry, you'll have this question. This I have taken it from your study material only. You will have a doubt which come in your mind. This question will remove that doubt. It will help me in calculation of intrinsic value, and then we'll go to that lengthier question. An investor, 30th question I am standing at. Investor is considering purchase of the following bond. Face value 100, coupon rate 11. Coupon is what the bond will give you on face value, 3 years. If he wants a yield of 13%, that means you want return of what? 13. What is the maximum price he should be ready to pay? Now before I start, I should know he is asking me to calculate the intrinsic value. What is my coupon rate? 11. Yield rate? 13. That means market rate is more than my rate. My bond will trade at discount. So one thing should be clear. Intrinsic value you have to calculate. Intrinsic value is nothing but, calculate quickly please. Intrinsic value is nothing but, calculate quickly. Intrinsic value is summation of present value of interest plus present value of redemption value. So let me show you the way of doing, so that for next question you are ready. So it's basically face value 100, coupon 11, maturity 3 years. Intrinsic value summation of present value of interest plus present value of redemption value. Present value, redemption value. Check your answer please. $90. You know what is the meaning of 95.27? If you invest 95.27 and receive these cash flows, your in-hand return would be equal to what? 13%. That comes out 95.27 intrinsic value. That formula you would know. Second is, if the bond is selling at 97.6, if the bond is selling at 97.6, what will the yield? You have to reverse calculate the IRR. Now there are two ways of calculation. Return formula you have to calculate. Basically you have to calculate, if you are getting the above rate and the bond is at this rate, then what is your in-hand return? There are two formulas you can use. One is your inter-level formula for YTM, which comes out as YTM is equal to, YTM is nothing but it's a return from the investor's point of view, cost from the company's point of view. Interest plus redemption value minus market price divided by N divided by redemption value plus market price by 2. That's shortcut formula. Is it valid for the exam? I have been thinking that every time institute will change, they will change, but they never change. I'll show you once, because The problem is it's a formula which is valid because you are seeing the applicability, although best formula should be IRR. The best formula should be IRR. This is which chapter we have? Bond valuation part of secret. Let me show you. It's IRR only. I've done by both the ways, but I'll show you what they have given answer. So I'm assuming in the exam they'll give the marks under what circumstances you should be applying IRR. Would be if they by chance mention two discount rates, then you're not left with the choice. You'll have to apply what? IRR only. This same question, I think this is the same question. This was the question. Below it is written Institute of Chartered Accountants of India. Their book only, please. All copyrights are with them only. Same question we are doing. Now let me see the answer 20th. Because that risk is with you only. I cannot help it out. I am still presuming that shortcut formula should be valid for the exam. Although they are trying their level best to convert to the IRR, but IRR calculation is a mechanical calculation. Calculator, it does not take even a 30 seconds time. In your case, when you start calculating, that creates a problem. Look at this. They gave first part was 95.27, then yield. They have taken IRR. I'll tell you how to calculate IRR alternatively. Look at the alternative. It's exactly shortcut, and they have been using. It's not common. It's here. If you are comfortable with using two discount rates and then calculating, IRR is basically a concept in which you can apply the interpolation. Calculate one rate, NPV comes what? Positive. Calculate second rate, NPV comes negative, and then apply. It's perfectly fine. If by chance in exam rates are mentioned in question, then you have no choice left. Then you have to use those rates. In case rates are not there, then I think take your calculative risk. It's okay. You can apply this. In fact, one of the question I'll show you, they have used so ordinary way of doing it. What I was doing in basic na. For example, if 10 rupees I have to earn 12% rate, what is the value? They have calculated that value for a bond which has a finite life also. So I think they are giving so many alternatives. They themselves are under the pressure that which answer will come, we do not know. So I think it is still valid here. This is the latest one which they have given for the new examination, and only one example was given. I just wanted to see if they would have given 2 or 3, I could have verified. So this alternative I have valid. In case it does not come, or if by chance they give a problem, then copy paste it along with the Institute of Chartered Accountants of India, send them back. You cannot do better than that. Otherwise, if you're comfortable IRR, then I'll show you that IRR how to use. In class, I do both of them. I give the choice, because if I use IRR, then someone will come, sir, if I'm not able to do what to do, it's tough. Then I use this. Number should be there. If you say no, they use IRR, then I use IRR also. Where gone IRR? Or part. Then I use this part. This example was just to show you both methods can be done. And in fact, you know why it was easier for me to use IRR here? The rates were, one rate was 11%, I know 11%, second rate 13, I know the rates very easily. In some of the questions, you might not be able to identify the rates. In case you are able to identify the rates 11, 13, 10, 15, and I think IRR concept, when they apply for the calculation of YTM, their objective is not the exact answer, their objective is basically the process. So if you assume two rates, then calculate positive NPV, second NPV would be negative, and then apply the interpolation. Rate would be roughly around same. In this case it comes 12.01, and in that case the answer came was 11.94. So it's up to you, both can be applied. If you go back, you can check that study material, it will be the latest one which they have issued. So that's the IRR. Intrinsic value is very common. Certainly one thing should be sure, that this shortcut method should not be reverse calculated for the purpose of intrinsic value. This is not to be done. This can be only used for the purpose of calculation of the YTM if you want. In case you are comfortable using this part, it's perfectly fine. That's up to you. That comes out. Now let's go back to the question what we were discussing. That's the question which we were discussing. Question number 23. I think this question would have some importance in the coming years, because a lot of rating agencies have changed ratings of the companies, countries, etc. after the war situations have erupted in few countries, and we are facing a huge amount of problem. So rating agencies are important. I'm not discussing about the rating agencies. It's a very important topic, by the way. Based on the credit rating of bonds, Mr. Z has decided to apply the following discount rates for valuing bonds. Credit rating. Credit rating is exactly same. Higher the rating, you get cheaper loan, or better rating of a country, better rating of a company, you get the debt at a cheaper rate, which comes out. Discount rate available. AAA rating will get bond the interest at 364 treasury bill plus 3% spread. AA will get the, it's a slightly lower, AAA plus 2%. 1A will get AAA plus 3%. I'll just briefly show you the ratings chart so that in mind you should know, because some of you might be joining these rating agencies because they hire CAs, and you should not sound dumb when you go there. At least the big names you should know, which are rating agencies. A slight change which can come in these rating agencies, for example. For example, some of the rating agencies which are important from the point of view of the markets are internationals are Moody's, S&P and Fitch. India, you have a CRISIL, ICRA, here. These are the rating agencies. Now, if you look at the rating agencies, they signify something. Its AAA rating is a highest quality you have. Then in between could be a plus plus also. I am just taken the basic work of it. AA, single A. Then you have, look at the part here when you stand here. If I go part here, part, that means as the rating goes down, the risk of the bond increases. The moment risk of the bond increases, the lending rate would increase. It's not that people will not lend. They will lend. For example, there are some countries which has defaulted. It does not mean that they will not get the loan. The person who has a higher risk capacity will lend them and will charge what higher return will be. When you go back and try to see where the India stands. So where are we standing and how much scope we have to improve. So you will go back and check that where exactly are we standing, and below this, if anyone is standing below that, that means it's a speculative or a higher default category or something. The moment it happens, for example, any country, let's suppose a defaults. If, for example, I'm just taking a rough number, let's suppose Greece. The Greece, for example, till the time I think they defaulted in 2013 somewhere. One of the countries, let's suppose, leave about that. If let's suppose any country has not defaulted, they have a loan taking capacity rate of a 3% as of now. The moment they default, the lending will not happen at 3%. It will happen at a very, very high percentage. It does not mean that lending will stop altogether. There are people who will lend at a very, very high rate of interest. So when you go back home, why I am telling you about India story is, we are still a long way to go to reach at this level. And the moment this budget which came out, I'll just take single minute please. Budget which came out, they are talking about fiscal consolidation. That means they are talking about reducing the debt level. And if that happens, by chance, if that happens, then the breathing space RBI will get, the companies will get, because if, for example, I am a government and I am borrowing a lot of money and my debt is very heavy, my rating is bad, and if I reduce my deficit and my borrowing decreases, my rating improves. The moment my rating improves, my borrowing capacity increases, plus whatever lesser amount I'll raise, the same amount the RBI would be able to give it to the companies, and there could be a private capital expenditure to happen. So this was interim budget, but I'll expect after your exam, do have a watch at the budget, some of the key points. You'll get feeling. It's not that market are running just for the sake they want to increase. Liquidity is one factor for the market, but big players are not blind enough that they'll keep putting in the money. There has to be something which they are seeing, maybe 5 years down the track, maybe 3 years down the track, maybe 10 years down the track. We are not able to see. So these play a very, very important role. That means any change which comes on the interest rate, market fluctuates very heavily, and countries' rating are very important. Companies' rating are very important. Very, very important. It comes out. So when you go back, it was just to tell you that these are some of the rating agencies. You should be knowing it because they are some of the high-paid companies, and work culture is also could be on the better side when you go out. When you go back, in your spare time, these topics I am discussing because I want, when exams are over, you have a free time of a month. then spend some time that whatever you have learnt, the applicability can be done practically or not. Theoretically, you know everything I know. Everything you know, every formula you know, question you know, this is in the study material, this came in the RTP, this came in this year exam, this came in that year exam. Means by heart you will know. By heart. Or if you don't know, your friend will call, oh, this question you missed out. It came in this exam. So you will know the answer also. Sometimes someone will show the answer, you will calculate the question also. You become so expert over a period of a time. I know that. But that is good enough because you have to score marks. Your paper structure is such, I cannot help it out. If had it been a regular classes, it's a separate case. The structure is such, it's not your fault. Budget 9. Where we wanted to go? Your structure is such in which you have to go the way it is. But my expectation from you is, again I am saying, pick up any topic of your choice, whether it's a bond market, forex market, equity market. Equity market is slightly easier because you understand balance sheets well, and the applicability and the attaching of the bond valuation is a complicated in nature, very frankly talking. Prima facie, some part you can make out, yield rate changing, interest rate changing, what is the impact, borrowing cost of the country is going down or not, borrowing cost of the company going down or not, that you can attach. But balance sheet is something which is day in day out you have been looking at and you can come to know very easily. So that I think equity market I feel sometimes better off for you as a career choice if you want to go into the financial side. Otherwise technical side people go, it's not they do not go. So rating what you see here, AAA rating will get treasury bill, it's a kind of a risk free rate plus 3% spread. AA will have a slightly higher AAA plus 2%, single A will get AAA plus 3%. He is considering to invest in AA rated bond. That means if you have 364 treasury bill rate as what percentage? 9. So this is basically 9% plus 3, that is 12. Your borrowing would be 9 plus 12 plus 2, that is currently selling at 102586. Now I can make out from here itself, my bond is selling at what? Par or a premium? Premium. That means if my bond is trading at a premium, my earning would be higher than the market. My earning, I can prima facie make out my earning would be higher than the market. Market yield rate is what? Discount rate this is? Discount rate or yield rate is same, 14. The bond has 5 years, coupon rate is 15. That means justified. Now whether it's correctly valued or not, that I do not know. My bond is giving 15 and market assume discount rate as what? 14. So my bond will trade at a premium. Premium it is trading at 1025 is the actual market price. Is it correctly valued or not? Which we do not know, which we'll find out. The next interest payment is due is 1 year from here and the bond is redeemable at par. You are required to calculate intrinsic value of the bond. Intrinsic value is IB 0. That means how many years will discount back? 5 years. Calculate for me roughly here only. Intrinsic value 0 would be equal to 15% coupon. That means sir 150 into annuity factor, discount rate is 14%, 5 years plus nothing said, redemption is 1000 into present value factor, 14% for 150, 3.433 plus 1000 into what? 0.591. Your intrinsic value is 1034. 3395. I am taking also I am taking 2 decimal because in the question he has given market price in what decimals? 2. So sometime logically also you can make out should I round off or not round off. It gave 1025.86, so I'll put my answer as 1033.95. As per me value should be what? 1033.95 available in the market at what? 102.25.86. So bond is trading at a, that means you should buy recommendation would come. Should for Z full stop, should he invest in the bond? Yes. Also calculate the current yield. Current yield means if he invests today and if he gets the interest today, that means if I buy today bond, I'll buy at what? 1025.86. I'll get interest at what? 150. What is my current yield? Means today if I get the return 14.62. 14. Then he says calculate YTM of the bond. YTM you can apply again the same. I think I have applied the shortcut formula. You can take two discount rates and solve it accordingly, get the answer. Gives me to have first part I took 14%. My value came 1033.95. The bond is undervalued because as per me the value should be 103.95, available at 1025.86. So he should invest. Current yield is nothing but interest divided by the current market price. Yield is basically based on the current market prices. That means if I invest today, I will invest at 1025.86, will get 150. My return is 14.62. And YTM is interest plus RV minus market price by N divided by RV plus market price divided by 2. It comes 14.30. Or you can take two discount rates, 14% and 15%, calculate NPV and interpolation. Answer would come approximately same. That will come. You can have that also. This question I am presuming important from the again current scenario. Next part is a replacement decision, which in every third, fourth attempt he gives question once because it has linked with the capital budgeting. Now since capital budgeting has been reintroduced, there could be a possibility he might give you replacement decision of a bond. Theory, 4th page I am on. Replacement decision of a bond. Under this topic, we will take a decision whether to replace the existing bond with the new bond or not. Company generally wants to redeem the existing bond with the new bond when the interest rates have fallen. For example, I issued something and over the period the rates have fallen, so I want to redeem the bond. In case debentures are redeemed before maturity, they would be called at an additional premium that is called call premium. Call premium is an expense for the company and that will save tax. No such premium is paid when debentures are redeemed on maturity. So nothing would happen. Now this could be something which is important, discount rate to be used. If question gives you rate specifically, use that rate. Means in case question specifies after tax cost of debt when they are issuing you, then use that as a discount rate. In case question is silent, then use interest rate into 1 minus T as a discount rate. Question will specify 70-80% time. Otherwise, you can apply is interest rate into 1 minus T as a discount rate when you are issuing new bonds. This will help for what purpose? Calculation of the present value. Now, replacement decision, how it is done is, it's actually a replacement decision of a equal life which you would have done in which class? Inter. Which inter? Let me show you. Inter only, let me take you. Chapter capital budgeting. Let me take. Very good. Replacement decision. And do a recap what you used to do. This inter, and don't worry, it will come in the final also. It's not so that two-way. You finals, it will save your time. Replacement decision, equal life. What you used to do was incremental approach. Initial incremental cash outflow, annual incremental cash inflow. So we left in the choice. So there is only choice you leave. Final also in the choice. Incremental salvage or terminal value, and then NPV. Positive, replace the machine. Negative, do not replace. If you cannot make a sense out from here, let me try this. Let's suppose old Activa, you want to buy new Activa. It's a capital budgeting, so Activa is an asset. When you buy, it will cost you what? 70,000. Buy new, sell old. Buy new. 3 time periods you used to compare. Initial is 0 period. So you buy new Activa, sell what? Old Activa. If you sell old Activa, basically how much 0 period outflow? 60,000. We used to call it as initial incremental cash outflow. Initial incremental cash outflow, buy new, sell old, 60,000. Then old Activa generates CFAT of 40,000, new will give CFAT of 15,000. Now don't worry how the CFAT comes from the Activa. It comes. I get up at 4 o'clock in the morning, newspaper selling. I go on old Activa that goes, I cover 3 kilometers distance, and that gives me revenue CFAT of what? 40. My friend suggested you buy new, your weight is heavy, buy heavy weight, and they'll go, more distance you cover, more income comes. No, part-time job, you are not advisable, you have exam on the head. CFAT 40,000, 15,000. Incremental CFAT, how much additional I earn? 25. I hope you are able to recall the steps. 25. Then last was what? End. 3 steps we used to do: initial, over the years, end of the period. Without diagram we cannot do replacement decision. I have a habit, whether I do the any kind of working in the capital budgeting, or I'll do in this chapter also in the replacement. So this is equal life. Exactly same thing we do in the replacement decision of the bond. Bond will be what? If I issue new bonds, redeem what? Old bonds. There was some costing on what? The old bonds. There will be some costing on what? New bonds. And then end value. I'll compare at 3 level. If that gives me a positive NPV, replace the bond, else do not replace the bond. Exactly same thing will remain. So if you go back the decision here, what will happen? The steps would be exactly same. The process has to be remembered. It's an initial incremental cash outflow, annual incremental. Sir, why first period cash outflow? Because when you're redeeming the bond, you might have to pay up what? Premium. That will lead to the cost, plus there could be some other issue expenses, flotation expenses. And over the period, sir, why cash inflow will come? Because your redeeming interest rates have fallen. Earlier, let's suppose you are paying 12% interest, now you'll pay what? A 10% of interest. So that will save some time. And then you calculate incremental terminal value, that's end value, which will be 99% same, 99, 100% comes same. And then NPV. If NPV is positive, we'll say replace the existing bond. If NPV is negative, do not replace the existing bond. This is exactly what used to come. Let me see, I've taken one question, 2, maybe I might have taken only one, and that to be lengthiest question I have taken. It's okay. I've taken the lengthiest one. Rest you can go back home, and easier ones you can do at home. Let me check once if I've taken any working. No, I've taken the complicated part only. Look at this part, please. It says Trans India Limited is contemplating is thinking of calling 3 crores 30-year bond, 30 years is 1000 bond issued how many years ago? 5 years ago with interest rate of 15. That means how many years would have lapsed? How many years lapsed? 5 years. Remaining life is what? 25 years. The bond have a call price of 1140. That means 1000 rupee bond will be callable at 1140. Additional you are paying how much? 140. Had initially collected proceeds of 2.91. Issue price, sir, if you look at, the value was 3 crores. You collected how much? 2.91. That means discount was 9 lakh. That was a 9 lakh original discount. He has given also 30 per bond. The initial floating cost when you issued 0 period was 3 lakh 60,000. The company intend to sell 3 crore 12% coupon rate 25-year bond to raise funds and retiring the old bonds. Objective is they redeem this 3 crore, issue new 3 crores. Old bond costing was 14, new bond costing would be 12. Remaining life is how many years? 25. Life of the new bond is also 25 years. It proposes to sell the new bond at their par value of rupees 1000. The estimated flotation cost is 4 lakh. This is new. That means if you issue new, additional cost will come as a 4 lakh. Flotation cost cash outflow is in the 0 period, but flotation cost write-off tax benefit will come over the years. If you go back to your accounts, you would have done, if you remove any machinery from your books, the accumulated depreciation attached to it is removed then and there. It means if any bond is removed from the books, if any unamortized flotation cost is there or unamortized discount is there, that will be removed then and there. That means they will be written off in the zero period. The cash outflow takes place in the zero period. Over the year it will be written off, and writing off is not a flow. The tax saving on that writing off would be a cash inflow. The company is paying 40% tax, and its after tax cost of debt is, this is discounting rate he is given, after tax cost of debt is 8%. As the new bonds must first to be sold, this is actually straightforward. I have taken a lengthier question. This is the additional line in this question. As the new bonds first to be sold and their proceeds then used to retire the old bonds, the company expects a new 2 months period of overlapping interest. This is of a overlapping interest. Overlapping interest is nothing but, it's basically when, for example, if you are staying in a rented house and if you buy your new house, there is a time period which takes maybe a 2 months time, 3 months time or 6 months time to move to a new house. You are paying electricity charges here also, you are paying electricity charges here also. You might be paying a water bill here also, you might be paying water bill here, so you might be paying maintenance of the rented house and maintenance of the new, till the time you shift completely. That means there is some overlapping period in which you pay the expenses for both. Similarly, when the bonds are redeemed, it's not overnight things will take place. I'll issue new bonds, money would come to me, I'll do some accounting, then I'll make refund process also will take place. I have to refund the old. So there could be time period when I collected money from the new, it came, let's suppose, on 1st April, but old people were redeemed on 30th of May. So the moment someone gives me new money, they will start their meter then and there. That means interest will start. And these people who are leaving on 35, they will take 2 months interest. That means I have to make payment of 2 months interest for both of them. Ideally, this interest should be discounted by a 2 months period to bring to zero period, or some discounting should be done, but for the sake of simplicity it is assumed to be in the zero period only. So discounting, we are not disturbing it. So overlapping interest is nothing but, overlapping interest is the interest which is paid on both the bonds for some time period, during the which interest must be paid on both the old and the new bonds. What is the feasibility of refunding the bonds? You have the data in front of me. I'll show you the line chart. Just keep comparing your data. The zero period, what we have is, if I go to new, issue new 3 crore bond, flotation cost 4 lakh. I'll just quickly copy them. Once you look at the data, we copy them on the line chart. Then I have an old bond is 3 crores. The unamortized, there will be a discount, unamortized flotation cost. Then I am paying a premium of 140 into number of bonds, and that will save me a tax. You remain in the book only so that you can compare the data points, please. If you look at the line chart here, I have given here only overlapping. Actually, I have given the sentence also. You can have a look at my slide only, 5th. But by chance it came here, overlapping. Overlapping interest is, in practical world, it takes some time to refund the old bonds after the collection of the amount for the new bond. The interest on the new bond starts as and when the amount is collected. Interest on the old bond needs to be paid till they are refunded. It means for some period interest will be paid on both the bonds. This is known as a overlapping. So this is actually a separate from normal question. If I look at my question now, look up please. This is question number 9 only, na? Old bonds. Zero period 3 crores. Face value 1000. Number of bonds 30,000. Call premium 140 into 30. This I am putting under zero period. Everything in zero period. Unamortized flotation cost is 3 lakh. Unamortized discount is 7 lakh 50. Sir, how do we get? We get is, how much was the old flotation cost paid? Old total 3 lakh 60. How many total years? 30. How many left? 25. So this comes 3 lakh only. 5 have lapsed. Similarly, discount. Sir, why are you writing under 0? I'll tell you why under 0 only. Unamortized discount 9 lakh was total. How many total years? 30. How much year left? 25. Overlapping interest. Overlapping is total 3 crore into what? 14 percentage into how many months? 2 months. So this will come 0 period. Now what will happen is, I'll show you only 0 period we are doing. If I go to new, in the new bond, raise 3 lakh and flotation cost what? 4 lakh. Now please look up and do not do anything. 0 period we are standing. The process has to be straightforward. Bring money from the new 3 crore, pay money to the old 3 crores. Inflow outflow gets cancelled. Make the payment of a call premium. Call premium will save tax then and there. That's conventional principle what your institute follows. So we have call premium paid, save tax then and there. Then new flotation cost is a cash outflow. We will not save any tax on it. This will continue for 25 years and then we'll save tax. Write off these two. 3 lakh write off, it will save tax in 0 period. 7 lakh 50 write off in the 0 period, save tax then and there. Make a payment of interest outflow, saving of a tax is a inflow. Let us do the numbers on the calculator now. Pick up your calculators. It's only inflow and outflow 0 period. 3 crore collection, 3 crore paid, nothing to be done. 3 crore collection, nothing to be done. 4 lakh, 42 lakh paid as a call premium outflow. How much is the tax rate? 40%. So you can do M plus button and M minus button. Accordingly you can do. This is my outflow 42 lakhs. My inflow would be tax saving into 40%. 16 lakh 80,000. Then new flotation cost is my outflow. Only outflow. You put it somewhere wherever you want to put. Then save tax. Sir, how much I'll save on? 3 lakh rupees when I'll debit to my income statement. 7 lakh 50 combined I'll do. 3 lakh plus 7 lakh 50, 10 lakh 75,000 debited to the income statement will save my tax at the rate of 40%. 10 lakh 50,000 will save 40%. That is my inflow. 4 lakh. Whatever it comes, 4 lakh 20. You have the numbers. 7 lakh is the interest paid assuming in the 0 period. Outflow 40% tax saving is an inflow. What is my net position in the 0 period? $29 lakh 20. If someone is not getting, don't worry please. It's straightforward exercise. We do what? If I look at my inflows here, issue of a new bond 3 crore, refund of a old bond. The way you write the line chart, accordingly make the answer. Payment of a call premium, tax saving on the call premium. Flotation cost of a new bond outflow. I'm putting negative as an outflow. Tax saving on unamortized flotation cost, because old bond, since they are moving out of the book, their respective discount, their unamortized flotation cost will move out, and I'll write off and I'll save tax on it. The overlapping interest we pay in the 0 period, we save tax. So my initial outflow becomes what? 29 lakh 20,000. That's my 0 period outflow. That means if I shift from old to new, my 0 period cost would be 29 lakh 20,000. Now let me see what will happen over the years. I'll go back to my line chart. What will happen? Old case, I was paying interest of 14% on 3 crores. That is what? 42 lakh. If I was not taking new, then what was happening in the old? I was paying 42 lakh as interest. And if I did not buy new, then my old flotation cost every year I was writing of what? 12,000. Old discount I was writing of what? 30. Please do not get confused, sir. We have already written off. I am saying if I would not have shifted, then what incremental is basically over and above. This I was getting if I did not shift to new. This I was getting if I did not shift to new. Now new will happen what? New will have interest of 12%. It will be 36 lakh. Flotation cost will write 16,000. If I compare now both of them, I'll say what? Earlier I was paying how much interest? 42. New I'll pay how much interest? 36. What is the saving of the interest? 6 lakh. If I save the interest, my income will go up. I'll pay 40% tax. 6 lakh minus 40. What is my net saving of interest every year? 3 lakh 60. That's one part. Let's keep it aside. That's one part. Second, new flotation cost I will debit to my income statement. It will save tax on how much amount? 16. Earlier I was saving tax on what? For 12,000. Only flotation I am comparing. Flotation cost new is what? 16. Earlier I was saving on what? 12. That means incremental benefit I'll get only on what? 4. 4,000 into 40. That's a tax saving. That's second part. So we call it as it's an incremental tax saving on incremental flotation cost. Third, earlier I was getting benefit of tax saving on discount. That was 30,000 into 40. Now if I shift to new, I will not get this tax benefit. It means opportunity lost. So on 30,000 earlier I was getting a saving of 12. This is the opportunity lost minus 12. Three things will happen. One, incremental tax saving of net interest that came out 3,60,000. Incremental benefit of a flotation cost that came out 1,600. Opportunity lost which I was getting earlier, but if I shift to new I will not get minus 12. So 3,60,000 plus 1,600 minus what? 12,000. So I get every year annual incremental cash in. Annual incremental cash inflow we get is 42, 360, 6 lakh, 3,60,000 comes. Second we have incremental tax shield. Incremental tax shield on incremental flotation cost 6,400 minus 48. Sir, how did you get? Now I'll get on this. Earlier I was getting on this. No matter how you do the mathematics, it will come 1,600. And I have lost an opportunity of what? Opportunity lost is 12,000. So my annual incremental benefit would be 3,60,000 plus 1,600 minus what? 12,000. It comes 3,49,600. And then last value would come same. Here also you pay 3 crores and here also you would have paid 3. Call premium is only paid when you redeem in what period? 0 period. Call premium only come when you redeem the 0 period. So that will only come. So you have nothing to write here then. It comes opportunity. Then third part I am not shown directly NPV 349,600 is this part. 8% discounting. How many years? 25. We get 337.31 980 minus 29.20 811 920. And now quickly cross check the numbers. Quickly cross check. Annuity factors. If nothing is sent, round off to 3 factors. 3 decimals. Click cross check the numbers please. Let's try one independent exercise. I'll show you the question. Will not have the, just roughly calculate the answer, compare the answer. Question number 28. You do not have question answer both with you. Can I imagine it? Testing of your skills. You do it, whether you make line chart, no line chart, directly do it. I'll just read out the numbers with you. ABC Limited has 300 million 12% bonds outstanding with 6 years remaining to maturity. Since interest rates are falling, ABC is contemplating thinking of refunding these bonds with a 300 million of 6-year bond carrying coupon of 10. So old rate is 12, new rate is 10. Issue cost of the new bond is 6 million, that's a 0 period outflow. Call premium 4%. So you will have call premium 4%, which is basically 300 into 4%, 12 million. Full stop. 9 million being the unamortized portion of the issue cost of the bond that can be written off no sooner the old bonds are called. It means there is a unamortization flotation cost, and if the old bonds are refunded, then they will be written off in the 0 period. Marginal tax rate 30%. You are required to analyze the bond refunding this. Quickly do it, please. 0 period, amount is same 300, unamortized portion is available to you. I just need the net answer from you, and then I'll show you mine. Much shorter as compared to the last one. Issue of new bonds, refund of old bonds, call premium paid, tax saved, payment of a new flotation cost, and tax saving on the unamortized portion written off of the old bonds. Issue of new, refund of old, call premium paid 12 million, tax saving would be into 30%. Flotation cost of a new bond, it's an outflow. tax saving on the unamortized flotation cost. The discount rate is not available. Nothing is said. You have a new interest rate is 10 percentage into 1 minus t. Interest rate into 1 minus t. That will be discount rate. How much? 7.6. Done. Let me we have comparison of old bonds 300 million, 12 million, unamortized portion, new bond this. A issue of a new, refund of a old, call premium paid, saving of tax on the call premium, new flotation outflow. I have written the bracket also, inflow, outflow, outflow, inflow, outflow, that if you want to make out, you can make out from here also. Inflow, outflows, and then you have this part 11.7 I am getting is the initial. 11.7 I am getting is initial. Second part, let's verbally discuss, then we move forward. Old interest I was paying how much? 36. New I'll pay what? 30. Saving how much? 6. Saving would be a 6. And tax pay at the rate of 30. 6 into 70 would be net interest saving. How much? 4.2, that's saving. Second, old flotation cost was 1.5, new is what? 1 million. I'll lose some opportunity here. Sir, why? Because earlier I was saving tax on what? 1.5. Now I'll save tax on what? 1 million. That means opportunity lost on 0.5. 0.5 into 30.15. So basically over the year would be 4.2. Sir, how? 36 minus 36 saving, payment of tax net, minus opportunity lost on additional flotation cost. So it will come 4.05. How many years? 6 years. And if nothing is said, discount rate is interest rate, new interest rate into 1 minus t. That's 7 percentage. And then we get factor. Annual cash inflow 4.215. Then we get 4. Done. Let's wind up here only today. In the day, class is 10 o'clock in the morning. Able to reach back home. Tomorrow we'll keep off. Intra I have a lengthy class off for you. Give me some rest because next week again will become hectic. Also, board meeting on Vodafone, so I have to keep track of my number also. We'll meet on Monday 5:30. Let's slightly come back earlier. Although if you are part of the group, I'll send the message 5:30, and we'll take the call on Monday. That next days we'll try something because my son comes from the school. I have to pick him up, drop home, and then come. So I ask him to take 1 day holiday. Tuesday anyhow is important. I have to take the details. 5:30 we'll meet on Monday. Tomorrow we'll keep off, and Monday we'll start. We'll finish off hopefully this, and we'll move to the forex. We'll move to the forex. So very important. The first class of the forex or first 2 hours would be the ultra important. If you are able to get in tone with how I do the forex, I don't think you will face the problem. Take care and bye bye. Thank you. Take care and bye bye. So tomorrow we are keeping off. Monday we are meeting 5:30.